starting the session. So ladies and gentlemen, my name is Raj Mishra, and I'm founder and CEO of Ideals Network. On behalf of Ideals Network, I would like to welcome you all to Investment Deal Summit 2021, supported by our knowledge partners, RNC ValueCon and Transit Corporate Advisors. I'm excited to see such a good response from delegates all across the globe. For those who are new to our platform, a small brief about our company. We are 5 years old events and training firm based out of New Delhi, and we have been organizing public events and training in India, Singapore, Indonesia, Malaysia, Thailand, and Hong Kong. Thanks to COVID, from last 1 year, we are organizing online events for so far delegates from 65 countries have attended our online events. COVID has opened Pandora box for few sectors, while many others have badly held. The picture is not only of one country, but observed globally. While there was bad news for GDP contracting in India, it did not stop foreign funds from flowing in India. We saw record FDI and FII flows during COVID times, and the trend is likely to continue. Markets are trading at all-time high, and it is believed that the last few months have been one of the best time for IPOs. Tech companies like Zomato saw a great response from investors. We're likely to see more tech firms coming up with their IPOs soon. The future looks promising for investors who are making big bet on India. We will try to discuss and cover these topics through our panel discussions today. I'm sure the discussion will be a good value to your time. With this, I would like to invite Shailesh Haribhakti, Chairman Shailesh Haribhakti and Associate. He's a chairman and on the board of many reputed corporates. He's considered as veteran in consulting world. Mr. Haribhakti, I would request you to share your views on the current deal scenario. But before that, I would request you to inaugurate our knowledge paper prepared by RNC ValueCon and Transit. As part of knowledge sharing initiative, our knowledge partners, Transit Corporate Advisors and RNC ValueCon, have jointly prepared a knowledge paper covering valuation, transaction, and regulatory aspects of investment deals. The foreword of this knowledge paper is written by Mr. Mark Zyla, who is also present in the summit. So I'll also request Mark, Chander, and Sahil to be on the screen so that Sir can launch the knowledge paper. Although it's a virtual sort of summit, so with your permission, sir, I can play a small video, which will be inaugurating the same.
Otherwise, I was going to launch it by showing a ship slipping out of its slipway.
Thank you so much.
Okay, all the best to all of you.
Yeah.
Thank you, sir.
Thank you so much. So this marks the inauguration of knowledge paper, and Sir Chander and Sahil have actually worked hard on this, and
Congratulations.
And we are going to release. We have already released. In fact, we are going to share with all the delegates. The link will be shared soon on the chat, so the delegates can also view the knowledge paper. Thank you so much. Sir, your keywords, please.
Well, Mr. Mishra, Sahil, Chander, Mark, ladies and gentlemen, I think this is an exceptional event. I'm so impressed that people from all over the world have joined to share knowledge about what is happening to our world. Our world has become a completely different place from what it was, maybe completely unrecognizable from where we were 1.5 years ago. And we all know what has made that change, that wrenching, overwhelming, comprehensive change happen. It's not just the pandemic which has done that to us. It is also the realization that we have done damage to our only home, planet Earth, of the kind and variety that is now coming home to roost. And therefore, over the last 1.5 years, the world decided to change course and change the way that we transact, the way we do mergers, acquisitions, restructuring, asset reassignments, IPOs, international investments. Global finance has completely changed. And we are seeing actions in the capital markets and in the markets for finance, which are almost extraordinary. First time that a whole slate of independent directors or directors at a large corporation like Exxon was upturned completely because of the way that they did not show enough commitment to make energy transition a watchword at the corporation. And we are going to see many, many such drivers of action. For those of us who have read the very thought-provoking annual seminar papers that came out of BlackRock, or that came out of Blackstone, or that came out of JP Morgan over the last few months, we see that there is this common thread, this common theme, which is running through all of them. It is now real that money will not flow until you have put your hand up and are committed to making the planet continue to be livable by the human race. The G20 defined that as keeping incremental temperature below 1.5 degrees Celsius. That is not going to be enough, my friends. It is simply going to fall short of what we need to do. The actions we need to take are going to be far more vigorous, far more time constrained, and far more driven by the actions of each and every one on this call. Every one of you is going to have this big influence because you will not permit money to move. You will not allow a deal to happen. You will not allow people to reassign their assets unless the overarching purpose, which today we define through 3 letters, E, S, and G, unless these 3 exist, you're not going to permit that flow of money, that flow of deals. And I would urge upon every one of you, whatever part of the work that you're doing, negotiating, valuing, structuring, complying with regulations, documenting, marketing, whatever activity you are doing, let these 3 letters, E for environmental stewardship, S for social responsibility, and G for purposeful governance, drive all your decisions and all your actions. Make this the overwhelming thought line surrounding your entire conference. It is crucial that we do that. Having said that, there's a tsunami of money which is chasing transactions. And why has that happened? The sole reason is that we halted many of the things that we were doing naturally in terms of consuming our resources, consuming our savings. We used to travel. We used to go from place to place. We used to send our children to school. There were charges for transporting them. There were charges for every little movement that we were making. We were having an adventure, a holiday, or whatever other mode of relaxation. All of that was denied to virtually the whole world for at least 3 or 4 months, at least on an average. And that led to an incredible increment to savings that was unanticipated. Add to that the fact that most central banks all over the world, and particularly in the United States of America, 20% of all the dollars that today exist are fresh dollars minted in the pandemic. Now that, and the actions of the ECB and the actions of the Japanese central bank and the actions of the Indian central bank and all of these central banks put together have released a tsunami of liquidity into the markets. And it has become the remit of each and every one of you to make sure that this huge tsunami of savings and liquidity generated from these two sources, individual savers and central banks, will find assets, opportunities, and value creation, which will not only help us to meet the challenges that we face towards our planet, but towards each one of us in the human race. And let me just identify 3 challenges that all of us will need to address through all the deals we do in the next few months and years. 1, we will have to make sure that where education was interrupted because either a child did not have a device or internet did not exist or digital content was not available, we must make sure that that changes. 2, we need to make sure that the productivity of our land keeps rising. And 3, we need to make sure that there's universal access to reasonable healthcare. And if you see all the deals happening, you'll find these 3 themes as recurring themes. Whatever tech you wish to define it by, these 3 themes will prevail. I wish all of you great success in wearing this key lens of ESG and making sure that every dollar, every currency that is deployed for a great purpose. Thank you very much. All the best to all.
Thank you so much, sir. Thank you so much for your kind address. With this, we mark the open of this webinar. And I'll request panel 1, moderator Sahil, to be there. And I'll request him. Sahil is partner of RNC ValueCon. He's going to moderate panel 1 on transactions. So Sahil, over to you.
Thank you so much, Raj. Thank you so much, Mr. Haribhakti, for the great keynote and welcome address. First of all, very good afternoon to one and all attending this program. In fact, a very good evening also to the friends attending from Southeast Asia, and a very good morning to our friends attending from Europe as well as USA. So we have over 20 countries and participating in this webinar, and shows the kind of interest that the world has today for India. And that actually is the theme of today's investment deals webinar, is primarily to see at what India is from the lens of the world, and to give them a ground reality as to what is happening in the Indian ecosystem, may it be the distressed asset space, may it be the startups, much talked about in today's market as well. So with this, I would like to, without much ado, welcome my fellow panelists. I request them to please turn on their videos as well. And I will have a quick introduction of one and all. I will start with Mr. R.K. Bansal. R.K. Bansal ji is the, welcome all panelists. Bansal ji is the MD and CEO of Edelweiss ARC. Edelweiss is one of the largest ARCs operating in India, and Edelweiss has been very active in acquiring as in resolving the NPAs non-performing debts in India. I would like to introduce Bansal ji, if you can continue to be on mute, please. I think there is some background noise. Thanks. I would like to introduce Mr. R. Venkataraman. Mr. R. Venkataraman is a managing director at Alvarez & Marsal and A&M, as they're what popularly called here in India. They have been a turnaround specialist and a part of a lot of large and marquee transactions and deals in distressed asset space in IBC and otherwise in India. And welcome, Mr. Venkataraman. I would like to welcome Inder Karla. Inder has been a founder and and partner at Transic Corporate Advisors. Transic is a transaction advisory boutique firm based out of Delhi, and Inder is very active in the startup ecosystem and fundraising space. And welcome to you, Inder. I would like to also welcome Yagnesh Sanghrajka. Welcome, Yagnesh. Yagnesh is the founder and CFO of 100x VC, and they are very active in the new age investments in the startup ecosystem, wherein they are very much ingrained with the founder and provide them seed capital and take them to the light of the various rounds of funding. Welcome, Yagnesh. And last but not the least, Prantik Mazumdar. Prantik is the managing director at CXM Group, which is part of Dentsu. And he's also a board member at TAI Singapore. And he himself has been a venture and angel investor, and he's based out of Singapore. So a very warm welcome to one and all to this panel, and a very warm welcome to all the attendees. So the world is looking at India, and I think all eyes are on India since a lot is happening here, and probably COVID, especially the way China has been behaving, is only adding to the growth and fueling the growth here in India. So on the distressed asset space, if you look at it on one perspective, before the advent of IBC, about 4 years back in 2016, India ranked 130th across the globe as regards the ease of doing business rankings is concerned. And today, as we speak, we are ranked 62, and the rank is just getting better by each passing year. So that 100% notch up is primarily because of the way India has handled its distressed assets and the advent of the IBC and what it has done to the country. It has also seen an influx of capital. It has also seen an entry point for global MNC and large investors in India and overseas to have an entry point into the Indian corporates and the Indian ecosystem. This is what in general has happened in the distressed asset space. On the other side, on the growth side, COVID has brought about a lot of tectonic shift, the way tech has been playing out. Today, most of us have been either working from home or continue to operate on working from home. So the technology has been changing, and with that rapid changing technology and lifestyle and changes, so have these startups been fueled by a lot of ideas, and these ideas have been put to at lightning speed, have seen the light of the day. So these are the two broad themes that we would like to touch base today in this panel. And I would like to open this panel by welcoming all the panelists. And I would like to start with Mr. Bansal. Sir, we have seen that the non-performing assets have been, India has faced a problem of the non-performing assets. And you being one of the largest ARCs in India, and recently the advent of also the bad bank, which is now called the NARCL, National Asset Reconstruction Company Limited. So how, and the ARCs as a whole playing a very, very vital and pivotal role, both in IBC, resolutions of loan in IBC, and otherwise in distressed asset space. So what are your thoughts, sir? I wanted to hear it directly from the horse's mouth regarding all this which is happening in the distressed asset space. Over to you, Bansal ji.
Okay, good afternoon to everyone. See, the distress asset space, if you really see the banks, last 4 or 5 years, we have been struggling as bankers with a large NPA percentage. This whole thing started, let's say, after 2015 with the RBI came out with asset quality review. And a lot of infrastructure companies went through a problem, and even steel went through a problem. So at one stage, out of about 13-14% stress asset in the banking system, and the total 10 lakh crore worth NPAs, about 7 to 8 lakh crore were mainly in the corporate segment.
Right.
Now today, last 3-4 years, we have been resolving these cases. And after IBC, which came in 2016, Insolvency and Bankruptcy Code, we have been able to resolve at least cases of about, let's say, worth 3.5 to 4 lakh crore. Partly resolved, partly maybe they are undergoing resolution. Another thing which has happened in the banking system, many of these cases now have got fully provided for, because these are 4 or 5 year old NPAs. So as per RBI guideline, the provisioning has become almost 100% in these cases. So many stress asset funds have come to India. Many ARCs are also doing this deal, and many promoters also do a settlement. Wherever there is a strategic interest and asset is good, something like steel plants, which we have seen, there could be a strategic interest buying also. If we see the out of first 12 cases which RBI came out with in 2017, 5 were steel cases. And in fact, out of 12, those 5 at least got resolved. With the balance 7, we are still struggling in some way here and there. Except 1 or 2, Alok Textile went through and all. So I'm just saying, I'm not using the names, but I'm just saying this because of steel and because of the commodity. The total recovery of the banking system, of the financial lenders in all NBFC, all NCLT cases up to now has been about 43% of the total claims out of about 340, 350 cases which have been approved, or rather 370. Now, the only difference I would say is if I exclude just 3-4 cases like SR Steel, Bhushan Steel, Binani Cement, and Bhushan Power and Steel, then the recovery percentage falls down to about 23%. So, which is almost the same which was there earlier before IBC. So, I would say IBC is good if there is a good asset, good company, and especially commodity sector, and if there is a strategic interest in buying. We have also seen number of cases where and a lot of media hype is being created that haircut is 96%, 97%, 95%. But it finally depends on the company. I mean, we have seen in EPC companies, I myself have 2-3 EPC companies where the debt is today 7,000 crore. And I'm struggling to recover even 200 crore out of that company. But the business model is like that. So it will always depend on the sectors. So, but the resolution will happen. And some cases in the banking system today are like that, where perhaps you have no resolution. So let us accept that situation, and we agree to graciously accept that business has failed and there is no value left, especially if you don't have any hard collaterals. So coming to your other question, which you asked me, NARCL or bad bank, I don't want to use bad bank in that sense, but National ARC, which is being promoted by the banks themselves to take care of these balanced assets, which, as I just said, you are not able to resolve. And some of them are, despite being in IBC, we have not been able to resolve. So these assets will be transferred to this NARCL, and most of these cases are 100% provided. So there is no book value left in the banking system. So you will give some notional value, maybe 10%. And then this will be done under 1585 structure. Typically in ARC language, we say 1585. What does it mean is 15% bank will get in cash and 85% will get as a security receipt, which is something like junk bond. And once you realize that money from these assets later on, that 85% proportionately will go back to the bank. But the only difference here is this 15% cash which is being given is virtually coming from the same bank who will be selling the assets, because the company is being owned by the same banks. So you have about 11, 12 banks and institutions which will be owning this company. It will be in a government public sector. And they will invest about, let's say, 5 to 7,000 crore, which will be the equal to 15% money. And 85% will be issued as a security receipt. And as of today, as I understand, government will be agreeing to give a guarantee to that 85%, so that it gives advantage to the selling banks, maybe from RBI perspective, for some regulatory dispensation. And whenever this ARC, and then there is another company called AMC, or India Debt Management Company, that will try to recover the money and resolve these assets. And once they are able to resolve, and that will remain technically in the private sector, where 50% will be with private sector banks and 49% will be the public sector banks. So that decision making is faster, unlike public sector entities which worry about 3 C's or 4 C's. So finally, once they get the money, this will go back to the banks, and then government guarantee will follow. But if there is any shortfall, then government has to pitch in. And as of today, the amount which is being talked about, government will guarantee about some 30,000 crore. So I think we have to see how it pans out. So as of now, banks have identified about 22 cases in the first list, which are being transferred. So my feeling is this is a good move from 2 reasons. One, the ARCs always struggle in aggregation. That means if I have 15 banks, to acquire from 15 banks, it takes time, almost 2 years sometimes. And we are not able to resolve the case if you have not acquired from at least 70, 75% debt. So here, the first day itself, you are able to aggregate, because all the banks have to transfer. And then, like say, existing ARCs like us, we ourselves also can buy from this national ARC, because I am getting the advantage of aggregation from the first. So I think it's a good move, and it all will also help the banks to clean up their balance sheet, plus also to do warehousing, which in banking system becomes difficult. I can wait once I transfer to ARC, maybe for next 3 or 4 years, like say power sector. If we try to sell today power plant, it is virtually 2 crore per megawatt. But if I feel that power will be good in 2 years, I can keep this in this ARC and wait for resolution. I will stop here at that point of time. So I think if anything is there, let me know. Thank you.
Thank you so much, Bansalji, for your very insightful opening remarks. In continuation to this, Venkataraman sir, I would like to come to you and take a perspective from your end as to, you have been involved personally also, and A&M has been advising resolution professionals, like we spoke about SR Steel, the largest resolved insolvency case in India. And otherwise also you've been involved in a lot of other distressed assets and advising other special situation funds as well as PVC funds. So what has your experience been as an advisor, and if you can walk us through that entire experience and share some insights, that will be valuable.
Sure. Thanks, Sahil. So, I will pick up from where Mr. Bansal left it. Fundamentally, any distressed asset, if we look at the root cause of it, either it's the over leveraging or the overall, the project cost through which it has been established, and the over leveraging aspect, which has actually created this distress. The cash flows and the fundamentals of the business are able to sustain a certain level of debt, and the moment you are over leveraging it, the system collapses. So we want to fix this problem. The banks and the other institutions need to take action well in time. Like the situation with Mr. Bansal referred about NARCL coming up and accounts which are being 5 years NPA and being transitioned. There may be exceptional assets only, which could still be surviving these 5 years of provisioning. What happens is the moment asset gets classified as NPAs, further credit lines are choked. They don't get working capital, they don't get capex for last mile. The asset starts deteriorating downhill, and it's a very steep downhill. So if you want to resolve it through the IBC, you need to get in upfront early. IBC should not be perceived as snatching away from a company from somebody, or declaring it bankrupt. I mean, the IBC construct has to mature out. It's a forum wherein you are given a moratorium, wherein a standstill is provided to resolve the asset. That's where matured markets like the UK and US have reached today. People voluntarily file for it, take benefit of that standstill provision, restructure, reorganize themselves, come out of it. and the business runs. Here, it's like fighting, it's a battle, right? And you push back really to the wall, and in terms of every little iota of, gap or, thread left in the system is being fought over to either, let it go in or let not go in. And this whole delay in admission is only hurting the whole process of IBC. If an asset cannot sustain the debt it holds and it cannot continue to service, it qualifies for a, insolvency. The objective should be to push it in, resolve it, come out clean, so that the creditors are benefited. So that, having said that, the interest from special situations fund, especially not so much from the private equity world, they would be typically looking at growth capital deployment. Either primary or even secondary should be fine for them. But special situations and distressed asset funds are really interested in the Indian market. But again, going back to which Mr. Bansal very rightly highlighted, asset quality. Is that asset worthwhile putting in money? Does that asset have something in it for a turnaround? And it can deliver certain cash flows. It may not go up to the level that it was in the prime years or the early years of the business. It could be an impact of the market. It could be a impact of costing structure, pricing structure, everything. But is there a window for that asset to continue providing regular cash flows? Those kind of assets, people are interested. They continue to show interest. They are willing to buy it on their own. They are willing to back other strategic players to secure it through insolvency. So they back maybe an ARC. They back, not an ARC, I would say, they back a strategic to buy out those assets. So that's what they really look for. And the second route through which they would ideally like to come in is buying secondary debt, pre-admission or immediately post-admission until resolution. So the banks might be willing to sell the debt at a discount, which a lot of these special situation funds would like to aggregate. The objective being aggregate to the level that they have a significant majority holding position, and then they can steer the resolution of that particular asset which goes into IBC. They have a 67% plus shareholding in the COC. They can very well steer where this company needs to go. The objective is ultimately this: most of these are national assets contributing to the GDP, contributing to the economy. The objective is not to kind of let that all squander away or get wasted. The objective would be to recover as much value as you can from these assets, barring those cases again like a pure EPC company where it's just a shell of order book and no assets underlying it. Nobody's going to touch it. So it's the interest from these funds are very specific asset classes, asset quality, ability to kind of turn around, and potential of completing its residual life of the asset with a reasonable cash flow. That would determine their interest, and that would determine the price at which they want to come in. The one other key aspect which every overseas investor is concerned while putting in money in India is about liabilities. And the IBC gives a platform for cleansing up that. That's the reason why they're all interested in looking at IBC situations, and an outside court settlement could still leave issues behind. And once they walk in, you can see skeletons out of the cupboard. So they want it washed clean, which the IBC provides. And so there is definitely interest. It's a wait and watch for them to pick the right asset. I would stop here for the moment in terms of what we have really picked up.
Indeed, it's a cleaner slate for sure, and that is definitely will add on to the transparency and hence will obviously lead to a better maximization of value. Great. So I think.
But one other input I would like to add, is that the judicial process need to expedite on the timelines, and all resolutions and all turnaround and all of these aspects are very critically time bound. The delay is actually hurting the asset quality.
Correct.
And that needs to be somehow arrested. So that's something which we need to improve upon. Starting off with 180 days to 330 days to 370. We have seen cases where resolutions have happened in 180 days. The judicial process has taken 270 days after that. So that should be ideally avoided. Minimize the litigation, use the existing established case laws to kind of dispose and give orders on some of these resolutions speedier way, it's actually going to help.
Sure. Great. Thank you so much, sir. And good to get your thoughts on this. And quickly moving on to the growth side of it, wherein, recently, I think everybody's been talking about Zomato and every startup founder wants to be the next Zomato exit in the, let's hear it directly from your mouth. You've been ingrained into the startup ecosystem. What are your thoughts? How is the funding environment in the startups for now? Any changes which you have seen during and post the COVID scenarios? And if you can talk a little bit for the exits that we have seen recently, and has also
Sure.
opened up the other large IPOs which are lined up in the pipeline. In there, over to you.
Sure. Thank you and good evening, everyone. So I think Mr. Shailesh has covered it well when he, in the opening remarks, he said about like how the situation has changed from the COVID times, right? So all of us, we have seen, right, what has happened during the COVID. Everybody was just stuck at their home and they were not able to go out, and even the funding stopped for the startup, I think, which we have seen, the people who are connected with the startup world, they have seen. With those 3-4 months was bad for everyone, including the startups, right? They were not getting funding. But what have happened after that, right? There was a lot of liquidity which has been pumped by the central governments, by again the saving, as Mr. Shailesh was saying. So that money and the digitalization which has happened due to has been again pushed the growth through 2-3 years forward, right? So that led the VC community or the PE community to see that this is coming in, and the amount of money which has come from the, you can say, again, from your government side, the stimulus, also on the savings from this, has come into this growth stage capital, right, for these startups which are there for the longer term, which people are seeing right now, right? And to add to that, what has happened, as you were asking about the exit options, right? So exit options have again created in India the options for the VCs to see it India as an, so it provides an opportunity for the VCs to exit also. Previously, what was happening is that if you were saying that Ps were not able to do the IPOs for the companies, right? They have to go to, maybe the companies have to list to maybe the US, they have to go to US or to the other country to get listed. But after this change of the SEBI guidelines, what it has given push to that, they have a clear path to exit also in India itself. So if you see Zomato, it gives a great, I think, response from everybody. And now we have seen that delivery, Nykaa, and you see this is the Paytm, Mobiquick, and all are lining up for the IPOs, right? What it does, it actually, it gives a faith for the LP community, which is limited partner community. It gives a confidence to them to invest in the Indian ecosystem again, right? They are backing up the VCs now based out of India, because now they can see that companies can list into India and it can really provide them exit, right? So that kind of again will push the growth story within India. And we have again seen what has happened in China right now, right? So there has been a tech crackdown by the government, right? Luckily, we might get benefit out of it. We are not sure as of now, but as the things will progress, we might see that the capital which has to go to China might come back. It might make some way to India also, right? Because there's again a lot of capital which has been pumped in during this time, right? The capital has to go somewhere. It cannot just sit idle, right? And the interest rate being so low at 1-2%, the VCs has to invest money somewhere, right? So India might be one of the beneficiary out of that trend. And just to add to this, yesterday I was just reading about the IMF chief economist. What she was saying is that the growth in the developed market will continue to be there just because they are getting vaccinated and the governments are not withdrawing the stimulus, right? So if the stimulus is not getting withdrawn, they are getting growth. You can say the LP community might invest or give more capital towards the VC community, because they might, the VC or the PE community has kind of given them the greater return maybe than the public listed company last 5-7 years. So the VC and PE community might get more allocation, and that might come directly towards the growth for these companies, right? So the future is great for, I think, the startup community.
I agree with you. I mean, couldn't have been a better time in for the Indian ecosystem. And I think COVID and China, in fact, it has only helped India. And it is clearly seen by the kind of blockbuster response that we've seen for Zomato and the kind of IPOs
I
which are
think we will
already.
see, yeah, I think we will see more IPOs and more growth. And I think the tech community or the new generation community, they kind of they relate to them, right? So if you see the people are talking about the valuation of Zomato being crazy, right? I think we will have that discussion maybe later on. But the new age doesn't feel that it's expensive, right? Because they can relate to it. They want to buy the companies which they can relate to. Maybe they can't relate to ITC, but they can relate to Zomato.
Yeah, great. Thanks a lot, Inder. I mean, let's see where does the next unicorn come from in India, and all our eyes are there on that. Great. So I will move on to Yagnesh. Yagnesh, if you can. So you have been working with the common man, the common Indian entrepreneur who has just ventured into a startup. You help them provide seed capital, see their ideas, see the light of the day, dirty your hands yourself, and handhold them. And please run us through this entire journey, and what has your experience been? Are there exits? How have COVID changed things? Tell us the India story right from your mouth, Yagnesh, from the lens of a micro VC. Over to you, Yagnesh.
Well, thanks, Sahil. I hope I'm audible. Um
Yes,
just
you
checking.
are, Yagnesh.
Yeah, well, thanks, guys. Thanks for this opportunity, and love to hear the views of all the panelists. And well, we bring a very different side to the entire story, right? The whole startup ecosystem. This is where Zomato probably was 10 years back, and somebody funded Zomato with a great hope. Uh, and we are into actually the startup ecosystem 2.0 actually is what I would like to define. Uh, we were in 1.0 maybe 2009 to 2019-20, and post COVID literally triggered off the 2.0 in our opinion. Uh, and because we post COVID, there's been a lot of transformation of businesses, and I'm not getting into details of what happened. Everybody knows about it. We're still discovering the full impact of that. Um, However, the startup ecosystem has actually grown stronger. On the back of COVID, we saw resilient businesses actually overcome the difficulties, right? So um, the good ones actually came out with flying colors, and resilient founders, persistent founders, those who don't give up, were the ones which came out, winners. And exactly the funding ecosystem has rightly rewarded, these founders with a lot of funding. And you're seeing the news practically every day. But just to give you another perspective, what we see in the news is just the tip of the iceberg. The actual revolution actually has started at the ground level. We call it at the bottom of the pyramid. So that's where we work, Sahil, and 100x at 100x.vc. We work with bootstrap founders. So when we started the fund 2019, let me just briefly capture the summary of the journey, and that pretty much will give you and everybody a little flavor of what's happening. So when we started the fund in 2019, all founders, all five of us actually came together and discussed the pain points of the startup ecosystem. And Sanjay, as you know, is a legendary angel investor, and he's been investing in the ecosystem for the last 9-10 years. What we really saw was that no one really was working at the grassroots level, right? So we see a lot of accelerators. Of course, they're doing a brilliant job of incubating, and a lot of efforts put in just making these startups more fundable, more available, VC ready. But there was this whole professional touch which had the VC experience lacking. And I have come from a VC background. I used to be working with Bessemer Venture Partners in my prior life, prior to a couple of my corporate stints. But we all felt that there's no one who is really working with the founders, making them VC ready. And when I say VC ready, it's right from the ideation stage, may it be a pre-revenue stage, may it be a minimum viable product, trying to scale, trying to find their first customer. A lot of people have brilliant ideas, they've developed good products, but there are no businesses who are ready to buy these products or services. So we really wanted to work on at this grassroots level, and we really started this whole journey of beginning to say that, look, fine, let's look at bootstrap founders. There are plenty of them, and the numbers was already increasing, as you know, right? We already have more than 65-70,000 startups registered with DIPP India, as part of the startup initiative by the government of India. And we are seeing that number grow pretty much every month. So we knew that there are people out there wanting to start up. Entrepreneurial wave already has caught the country. But how do we channelize all of this so that we get more and more viable startups who are able to be funded? And that's a very big statement. It takes a lot of effort to get them ready to get funded. So we started working at that, and we started our first class, and we invest in a class mode. We did our first 20 investments in 2019, and then post that in January, February, pretty much March 2020, we had the pandemic hit everyone. Of course, things halted a bit, but then we funded our second class in September 2020. And so far, we've invested in 50 companies. What we've seen common across, is that a lot of the new entrepreneurs, and by the way, there are student entrepreneurs, there are young entrepreneurs, there are experienced entrepreneurs who come in the front, start, and they've been working in some corporates, but haven't been able to address certain key issues while they're working in their corporates, doing their job 9 to 5, and pretty much not able to really make a difference to the entire system. When you're working in a corporate, and I've done that for 25 years, what you are impacting is just one organization. But when you start working for a fund, you're part of the fund, you're funding companies, you then become part of the whole ecosystem. You are able to impact many more lives. So, 50 companies that we have funded have impacted more than 150 founders, have created almost 600 jobs so far. And so we feel really, we take pride in doing that. And, these are founders who are, coming out of colleges, coming out of IITs, some are experienced. So we really have to work closely with them. We started a unique way of investing, which is through the iSafe, and that kind of eases out the whole investment process. So we made it frictionless. So we found a founder-friendly document, which kind of most founders don't understand how the whole investment documentation works. We made it very simple into a 5-page document. So some of the experiences that we have seen, founders understand their business, but don't understand the laws, don't understand the huge documentation and the legal language. So how do you make it easy? So we worked on that, did that, and thankfully it's been successful. 50 companies that we have funded, 80-90% of them have already raised their seed round. So that just validates not just our success, but it also validates that this whole ecosystem is now mature. You're able to see more companies coming out raising seed rounds, and these are the ones who are going to become unicorns in the next 5 years, 10 years. That's what we are trying to create, and that's pretty much our journey so far. Happy to take more discussions and questions ahead.
Thanks, Yagnesh, for your perspective on that. What I will take the liberty to ask you one question. There is one question addressed regarding what startup sectors are you seeing super high transaction? So if you can just quickly throw some light and your experience on that, if you can name a few.
Sure, very valid question, Sahil. We're seeing a lot of these sectors, new sectors coming in. Some of the less favored ones have now become more favored, like you're seeing this whole wave of B2B SaaS technical startups, which were, in the fringes, but now they have come ahead. They're finding solutions for verticals that we didn't really understand before. So, some of these B2B SaaS startups have come up very well. Some of them have funded. We have more than a dozen investments in B2B startups. There are women entrepreneurs who are bringing in, e-commerce platforms. So e-commerce is absolutely right in the front, as you would imagine. But yeah, there are deep tech, there are robotics. We've even funded a drone company. So these are the sectors which are now coming up. EduTech, of course, has always been there and just kind of propelled more after the COVID situation. But now all EduTech startups will have to really think hard, because now we are looking at a hybrid future way of working and learning as well. So somebody who's going to be working at the hybrid model, with a lot of combinations there will succeed, and we are seeing that happening already. So yeah, I mean, EduTech, AgriTech, B2B SaaS, all of this is actually now happening very much, and these are the deals that we are looking at. Of course, also new things like, automation, RPA, robotic process automation. These are things which help enterprises scale with less time to market, and just speeds up the time to market as much. These are the tools that kind of are the future of work, and that's what we are investing in.
Great. Thank you so much, Yagnesh, for your grassroots experiences that you've shared with us on this. So, having heard from the four panelists, who have been stationed and physically located here in India, I think it will be very important and relevant to get a perspective from Prantik Mazumdar. Prantik is stationed in in Singapore, and he looks at investments flowing into India. So, Prantik, if you can throw some light onto how does Singapore or the Southeast Asian markets look at India at this point of time, and has COVID all the more fueled up the interest levels that the Singapore and Southeast Asian markets have in India? And there is one question, and I'll take the liberty to throw that at you, Prantik, is that there are other investment alternatives at other countries also, maybe Bangladesh, or depending upon what is the Korea, Japan, and others. So how do you compare India versus these other investment destinations, and your thoughts on the whole? Prantik, over to you.
Thanks, Sahil. No, thanks for having me, and good morning, good evening to everyone. So yeah, I think from that perspective, I think India has always had a very, from a Singapore lens, both geopolitically as well as from a investment and commercial perspective, India always has had a very good, perception in the Southeast Asian ecosystem, especially Singapore. Singapore genuinely looks up to India because of, the trade relations as well as geopolitical relations. I think in the recent past, there's been some great, I think Inder spoke about Zomato and a few other cases. I think if you look at the sovereign wealth funds of Singapore, Temasek and GIC, I think they've been very active in India for the last 15, 20 years, right from the famous Airtel deal to now all these startups that you're looking at. So I think typically in Singapore, I think everything is top down, right? So I think if Temasek and GIC lead the way, I think that sends a very positive signal. And then you have various other family offices, various VCs and Ps. So I think it's a given. I think India's a market that can't be ignored. I think the sheer amount of capital that the Indian startup ecosystem has kind of attracted. I mean, I think recently there was a great story about even the likes of Tiger Global in the last 6-7 years, right? From their the Flipkart, the famous Flipkart deal that Leaf Excel led. I think there are some very good signals. So I think from a investment perspective, I think India is in a very good position. I think Singapore plays the other role as well. I think a lot of the Indian startups, and maybe this is an opportunity for India to kind of perhaps figure out alternatives, because what we're also seeing is a lot of Indian startups typically end up, basing their headquarters out of Singapore, just given tax structures, given the financial opportunity out here, right? So it's not really that they're basing out of, so there are some that base out of Singapore to tackle China or to tackle Southeast Asia, but many of them, I mean, Flipkart is a classic example. There's been a lot written that perhaps Singapore gained more than India when it came to financially, simply because, Singapore has those tax advantages. It's very, very investor friendly. And maybe that's an opportunity, even from an angel investor perspective. I've looked at a lot of deals in India. And of course, I think, Yagnesh was speaking about, I think there's just so much happening and there's so much opportunity. One thing that I would like to see differently is, I think if the tax regime or the structures are more favorable to foreign capital, whether at an angel level or VC level, because that's something one has to factor. For example, of course, Singapore, Dubai, Hong Kong, the countries are structured where, capital gains is non-existent or rather low. Corporate taxes are, non-existent or rather low. But I think if something can be done at an angel level, I think India will benefit tremendously, because I think, as we heard in the keynote early in the day, that there's just plenty of capital looking to be deployed. And I think India is at this cusp with, unicorns and soonicorns being formed across multiple sectors. So I think it's a positive outlook, but I think from a taxation perspective, from a structural perspective, I think there is still a bit of way to go, but as Inder said, good to see that exit options are plenty, within the Indian market. To your other question of alternates, I think Bangladesh is a very good example. I personally am seeing, sitting in Singapore, I think what they have done very well is they again maybe behind the curve from India at a startup level. So you're probably seeing a Zomato equivalent or a Byju's wannabe emerging from there. Again, very similar model. Most of those good startups like Shahoj, like Shikho, like Shuttle, many of these guys are just basing their headquarters in Singapore. They typically have a resident director, and they're leveraging on high net worth capital from here to get their initial checks. And then, of course, the Sequoia Surges of the world are kind of coming and pulling in capital to kind of take them ahead. But I must say, what Bangladesh has done very well is on the broader what they call the PEST indicators, right? Your political, economics, social indicators, they've actually done very, very well. Even if you look at their growth in per capita income, I think that's done tremendously well in the last 7 to 8 years. So I would definitely look at, Bangladesh being the other opportunity where a lot of the Korean, Japanese, or Singapore, where, capital is relatively cheap, or Japan, where it's negative interest rates, they're looking at these opportunities as well. Closer to home, I think the two other places which have tremendous potential for investments is Indonesia, Vietnam. So if you look at Southeast Asia, collectively, Singapore is very small, 5 million, right? Smaller than any major city in India. But if I look at Indonesia, Vietnam, that's where honestly, where the action is within Southeast Asia, right? So Southeast Asia as a whole, the 10 countries make up about 600 million people. About more than 50% are on the internet. So again, I think Indonesia, Vietnam, probably slightly again behind India on many of these the startup ventures. But again, if you look at B2B commerce, you're seeing Misho, Udaan equivalents come up in Indonesia. Like the Zomato IPO case, Bukalapak is looking to list within Indonesia itself. You have the massive 40 billion Grab and Tokopedia SPACs, which will send a very positive signal. Shopee, which went public in the US market, was obviously the first success story, major exit success story from Southeast Asia. But what's changing is, I think you have new exit models like SPAC coming into being. You have exits within the country like Indonesia. And also, I think Vietnam as a market, to me, after Indonesia, is massive. I think, be it in terms of fintech, digital banking licenses, or even logistical opportunities, right, are kind of coming to the fore. And if you look at Vietnam, for example, a lot of Korean and Japanese money is flowing to Vietnam as we speak, apart from money that is kind of housed in Singapore through VCs and PEs. So I think there is good, healthy competition. But I think to your original question, I think absolutely, I think especially with Temasek and GIC, I think the intention is very clear. They all want to capitalize on, right from early stage to late stage opportunities in the Indian startup ecosystem.
Great. Thank you so much, Prantik, to give us that perspective. And we are running on time. I would have liked to, give another round of closing remarks to one and all, but unfortunately, because of the shortage of time, I have not been able to do that. But I would like to take an opportunity to thank all the panelists to share their valuable insights. And I think we very well covered starting the distressed asset space, what is happening, how are the funds viewing India, what is the kind of value creation and the resolutions happening on ground. And then we looked at the startups and the entire startup ecosystem blooming, changing, defining, redefining. And then we in the end spoke about how the Southeast Asian markets look at India and how they compare it with the other investment alternatives that they have. With this, I think we have done justice to the time that has been allotted to us. And with this, I would like to hand over back to Raj. And thank you so much, audience, and thank you so much, panelists, for your inputs and insights on this wonderful panel. Thank you so much, Raj. Over to you.
Thanks, Raj. Thanks, Sahil.
Thank you so much. Thank you so much. Thank you. So with this, we'll move to our next session, which is Keynote with Nick Talbot, who is CEO of IVSC. So thank you, Nick. Thank you for accepting our invite to come here. And audience are looking for you, and they would want to know what is the update on the valuation, what is IVSC doing to the future of valuations. So over to you, sir.
Thanks. Can you hear me okay?
Yeah.
Yeah, okay, great. It's a real pleasure to join your conference, and hopefully the next time we have one of these, it can be in person. But I recognise the constraints that face us all around the world at the moment. And my name is Nicholas Talbot. I am the Chief Executive of IVSC. For those of you that don't know us, we have a couple of key aims. One is really around having standards in place, high quality, consistent standards in place for all forms of valuation that are used everywhere in the world. And the other key component that we look to encourage is very much around professionalism, because we can put the best standards in place, but unless you've got professionalism there in each country, then actually it's meaningless. So we look very much to work in partnership with different countries, different organizations and different individuals. But what's the point of having an international approach? And when I think about this, I actually tend to think about sport. And normally I'd use football as an example, but recognizing I have a slightly different audience here, I think I'd use cricket, although I know it might confuse any of my American friends that might be on this too. But imagine if every country in the world that played cricket had different rules, and a different approach. We would have no idea who was ahead, who was winning, who the best team in the world at cricket is. Now, imagine international investment. Do you really want to have to understand 195 different approaches to financial reporting or to valuing an asset, whether you're looking at it from an investment point of view or indeed whatever point of view you need a valuation for? Ultimately, this is a competition for inward investment, for FDI, and investors want confidence. They get that from quality internationally defined approaches, as well as strong local professionalism. Now, all of that said, frankly, I think there must be something wrong with the international approach to cricket at the moment, because when I looked up the rankings earlier today, expecting to see the Indian cricket team at number 1, I was surprised to see New Zealand at the top, and except, of course, for 2020, where it was England. So I think the format for 2020 is still actually fine. In terms of how we work, we look to bring together an international approach by taking the best ideas from wherever they are in the world. And we crudely split the world into 3, so tangible assets, business valuation and intangibles, and more recently, financial instruments. And we're looking very much to have a collaborative approach. So we work with other standard setters, such as IASB, FASB, IAASB, professional bodies, major corporates, either national or international, some of the biggest banks in the world, some of the biggest investors in the world, as well as data providers, auditors. So we really look to bring together the whole ecosystem. And our boards have India representation. And in fact, when I look at the organization that we've developed, we have over 170 members and sponsors from around the world, and 13 of those member organizations actually come from India at the moment. So quite an influential representation from your part of the world. That said, if any of you want to get involved, you're always welcome. We welcome applications to apply to be on these boards every time we open them. And we really look to get the best talent from anywhere that it is in the world. So we really want to get your views and input. And shortly on the panel, you'll hear from Mark Zyla, who chairs our standards review board. And that board oversees all of the different approaches that we have, the specialist approaches to tangible assets, business valuation, intangibles, and financial instruments. I think that the COVID situation, the health crisis that has been so tragic for all of us, is obviously developed into an economic crisis of sorts, and countries are starting to emerge at different paces. And we've done things to help on that in terms of what to do in times of uncertainty. But actually, we've noticed more and more interest in having that globally consistent approach to valuation. Now more than ever, the role of a quality valuer is really important in terms of restoring confidence to investors and economies around the world as the world starts to emerge from the COVID crisis that we've seen. One of the recent groupings that we've put together is bringing together some of the world's biggest investors into an investors forum that we have. And we've also got a grouping, a valuation working group with some of the world's leaders of some of the world's most influential regulators. And actually there are some strong themes that come from both, in that both want to see global quality and consistency. And they need that not just in each local financial system, but actually at a comparable level, country to country. So that's something that's really important, unsurprisingly, I would say. And hopefully the steps that India has been taking will build towards that as well on a local level. ESG, this won't be a surprise to you, but obviously this is something that's hugely important to every one of us, every country, as we look to avoid the climate crisis becoming bigger and bigger. But in terms of practical steps, I think we're going to see more impact from what will be the Sustainability Standards Board, which is being created by the IFRS Foundation. And that will obviously have a reporting impact, and it will drive the behavior, I think, of some of the market participants. And that's strongly supported by the UN, IOSCO, organizations like that. And I think that will obviously have an impact. At the moment, the investors that I speak to, they see the qualitative information that's out there, and some of them really have a strong urge to participate. But from a valuation point of view, what they really want to do is understand the quantitative impact. So if it's climate change, well, actually, you know, if you invest in a beer factory, will it have a water table there in 10 years' time? If you're buying beachfront properties in Miami, you know, how do you factor in things like the rising sea levels? So there are lots of very reasonable but clever questions out there. And one of the things that we're working to do is bring together stakeholders so that we can evolve the standards to try and answer some of these tricky questions that are out there and play the role that is needed, because with whatever reporting system the world comes up with, valuation is going to be a key factor in that. And actually the value of different assets is going to be a key driver, I think, in behavior in terms of ESG and trying to actually make improvements towards that. And as we see increased regulation around the world, that will also obviously have another key impact. I'm now going to open up and hand over to what is an exciting and interesting panel 2 on valuation, which brings together some very distinguished speakers from across the world. So I thank you, and I hope that you enjoy the rest of today's conference.
Thank you, Nick. Thank you so much. And thanks once again. IBC is doing an amazing job, especially in valuation and bringing the valuation community across the globe. So thank you once again. And with this, I'll request Chander to take it over. Chander, panel 2. Chander, you are there?
Yeah, Raj, you need to switch. I can't enable the video.
Okay. Right. Now you can, Chander. So, Rajan, Ashish, Mark, and Vineet, welcome to the panel. And hand over to you. Thank you.
Yeah, thank you so much, Raj. And there is some noise coming. Yeah. So I welcome everyone on the panel discussions on valuation. It is an exciting panel and very interesting, as we have Mr. Mark Zyla from USA, who also brings, besides being a practitioner on valuation, He also comes as the chair of IBSE Standard Review Board. Mr. Ashish is coming from Duff and Phelps. So again, bringing in perspective from Singapore and global perspectives. Mr. Rajan Wadhawan is from PwC, and again, he's a practitioner. So he will be sharing his perspective on M&A aspects. And we have with us Mr. Vineet Rathi, who comes from a registered valuer entity. He's a partner of RNC ValueCon. So it's very interesting time because, like the first panel, we all discussed that, see, there is a lot of money that's waiting to be invested in different parts of the countries. But COVID has only subsided the investments, and slowly and steadily we have seen that the M&A activity is increasing. We touched upon some aspects of Zomato valuations, the recent startups, and different perspectives. So what I'll do, I'll just take it step by step. And first, let's understand about the global perspective about how IBSE standards are helping the global economies. And it's very important because at the same time in India, the Indian valuation standards are under formalization. So may I request Mrs. Zyla to share his perspectives on IBSE and if there are any learnings that as an Indian fraternity we can make at the moment. Mrs. Zyla.
Thank you, Chander, and thank you so much for the invitation to speak to you this morning or this evening, your time. As Nick mentioned, as Chander mentioned, in addition to being a practitioner here in Atlanta, I also chair the Standards Review Board of the IBSE. And the function of the Standards Review Board within IBSE is to harmonize the standards for, which is referred to as IVS, which is the only global multidisciplinary set of valuation standards. And we work with 3 technical boards: a business valuation board, a financial instruments board, and a tangible assets board, and develop a comprehensive set of international global valuation standards. The reason why this is important, if you think about valuation, and if you think about, say, for example, the merger and acquisition process, valuation is a vital part of that process, and it's a vital part of well-functioning global capital markets. So if you think about just a typical M&A transaction, when you're doing a deal, the target, there's a valuation of the target. So how much we need to pay for that target. There may be tax consequences to that transaction. So therefore, there may be a need for a valuation for tax purposes. Under both international accounting standards and here in the United States under US, need for financial reporting of that transaction, of identifying the value of the individual assets that are acquired. So that requires a valuation. If there are issues with the transaction, if there's eventually an insolvency, the insolvency might involve a valuation. If there's litigation resulting from the transaction, that might involve a valuation. So it's part of just general transactions. There are numerous reasons why there's a need for valuations. And it goes to back to what Nick was presenting. There needs to be a common set of standards. So if a valuation is done in Delhi or Denver or in Dallas or anywhere across the world, there needs to be consistent methodology, ways that the valuation is doing in order to enhance the efficiency of the capital markets. One of the things that we as a profession are struggling with is, are we operating in a manner that enhances the public trust? And I think that the IVSC goes a long way to answering that question. If you think about valuation compared to other professions, if you are an accountant, you follow accounting standards, you have a certain set of education requirements. Sometimes you have to have a accounting license, depending on which jurisdiction. If you make a mistake, there are consequences. if you think about it as a lawyer, if you're a lawyer, you have to have a common set of education requirements. You have to have, you follow certain procedures as promulgated by the bar in various jurisdictions. If you make mistakes, there are consequences. In the valuation profession, there really isn't that same level of consistency across the profession. So there have been some concerns from regulators, as we've seen in India, in the United States with the SEC, that there's been some concern expressed about our profession. Because of what we do, and it's involved in the public trust in transactions, in financial reporting, in tax work, the regulators concerned about the consistency and the quality of valuation. So I think the IVSC goes a long way of setting common set of multidisciplinary global set of standards. Some of the projects that we're currently working on to enhance IVS, the current set of standards is referred to as IVS, or International Valuation Standards. As Nick was mentioning, we have well over 100 organizations that follow some form of IVS. We also, as Standards Review Board, one of our roles is to be a voice of the profession. So we provide advice to other standard setters as far as providing input as valuation components of, for example, accounting standards with the IASB, with the Financial Accounting Standards Board here in the United States. We've had conversations with organizations like IOSCO about valuation issues as a general concept. We've had conversations with large banks through our Financial Instruments Board to setting financial instruments standards worldwide. Some of the projects that we're currently working on that we see the future of the valuation profession, one that's been mentioned a couple of times during this webinar, is ESG. We see ESG as an important, not only important issue today as a society, a global society, but it's an important issue within valuation. If you think about ESG, there's three kind of buckets of measurement. There's the measurement of actually the impact of ESG, which we see through some ratings agencies. There's the financial impact, financial reporting impact of ESG, which we're starting to see with organizations like the IASB in developing a sustainability board, and the EU in their discussions with FRAG as far as developing accounting standards to measure ESG. And then the third concept involves us, valuation specialists, because ESG has a critical component in investments. As the keynote was mentioning earlier, a lot of investment funds are focusing on ESG issues. Well, the question now is, how do you measure that valuation impact? And so we, as an organization within the IVSC, we're starting to gather information, how ESG is being considered in valuations, how technically you measure the impact of this really complex issue. So we're looking at ESG. Another area where we see a growing interest is internally generated intangible assets. As the economic consequences of the pandemic have accelerated the trend towards more technology-based sectors, we see more value going to those particular sectors. When you look at the market cap to the book value, the question is, how do we measure that? How do we measure the value of the intangible assets if it's not being measured by financial reporting? So we're looking at internally generated intangible assets. We're working with accounting standard setters similarly to look at how goodwill is being measured and what exactly is goodwill that's resulting from transactions. A key issue that we're working on through our Financial Instruments Board is setting common global financial instrument standards. That's been an issue, of course, in the financial crisis in 2007, 2008, where there was not a common set of valuation standards for the securities that caused the issues in the global meltdown of that particular crisis. So we're working to set a common set of valuation standards in financial instruments. We're also dealing with and helping the profession deal with issues like market uncertainty. How do you deal with valuation issues caused by the current global pandemic? So with that, I'll leave it to the other panelists, but I just want to encourage adherence to and think about recognition and adherence to common set of valuation standards, because it aids the public trust in the work that we do.
Yeah. So I'll just take it from where you have left, Mark. You just touched upon technology companies and how the valuation is getting shifted to the technology companies. And see, I'll just give a small example. On 23rd of this month, Zomato got listed. And if you look into the market cap of Zomato today, it's about 1.1 lakh crores. So it has a top line of about 2,100 crores. It got listed at a market cap to sales of 28 times, which Mr. Damodaran had valued at about 41 rupees. It got listed at 76. Yesterday, Friday, it was, I think, 136. So it has grown about 90% over and above the market price in less than a week. So getting about 50x of top line. So I would ask Ashish if he can give some perspectives on the early stage companies, because so far what has happened that when we were valuing these kind of companies, there were not enough comparables in Indian markets. So we were looking at, global markets, Alibaba, Amazon, those kind of companies. But now with Zomato, there will be Paytm, there will be MobiKwik, there will be many companies. So how should we value? Can we actually value it? Because you need to also look at it from regulatory perspective. Regulators are asking you to follow a particular methodology. And if you don't follow the methodology, and if there is a gap, then there are tax elements also involved. So Ashish.
Thank you, everyone, and glad to be on this panel with the esteemed people on the same screen. Just taking from what Mark said, see the one of the key things that IVSC talks about and what the IVS talks about, and I happen to wear a second hat of being a standards and technical work group member for the Institute of Values and Appraisal Singapore. So one of the key things that we always talk about, what is the purpose of the valuation? The purpose then defines how you go about doing the valuation, what's the basis of value that you use, et cetera, et cetera, et cetera. So when you look at something like Zomato going at 28 times, trading today at 50 times, for a company where of the stage that Zomato is in, 40 times, 50 times of revenue is not off the chart. Now, whether that is a sustainable multiple, definitely not. Because anytime when you're talking 40, 50 times multiples on revenue, there's a huge amount of growth built into that. So if you even look at things like, say, look at an Uber, which got listed a long time back, or look at Lyft, which got listed a little while back. They were also at that point in time trading that high, because they weren't at the 28, 50 times. They were probably at about 20, 22 times. And over time, they have stabilized on that multiple. It's still a higher multiple compared to traditional businesses, but they do stabilize. So to your question on what is driving this 50 times, one, I think what the previous panel said, there's a lot of gunpowder. So that's where the private equity and the funds are coming in. People need to justify their living. They need to justify the fact that they need to put in the money and make it to use. Everybody has their 220 to worry about. And the other thing is a lot of, if I put myself 20 years back when the internet bubble burst, before that, a lot of people made money on it. You go back to 2008 when the GFC happened. Again, a lot of people rode the wave and made money on it. And more often than not, you hear of these success stories rather than the people who jumped off of buildings. metaphorically and otherwise. So there is this whole bunch of 20-somethings who have started earning, believe in these business models because they are the ones who are using it and are willing to put their money into these investments because they believe it's going to grow. So that's where the retail investors are coming from. So if you kind of try and break down who's trading on these tickers over the last since 23rd, you'll see it's going to be a mix of a lot of the individual investors trying to ride the wave, and a lot of funds who initially came in to make the investment and use their gunpowder to that extent. We also happen to do valuation for funds. So the same question that is trading at 50 times, why can't I get 50 times today? Well, you have to look at what is sustainable. And when it comes to financial reporting, people tend to be more conservative. So those are parameters that come in. I can see Mark smiling. Yeah, philosophy remains the same. You got to be conservative when you're reporting.
Yeah.
Hope that answers the question, Chander. Happy to go into more details.
Yes, that gives a perspective. I'm not sure whether that answers or not, but thanks for that.
There are no right answers right now.
There are no right answers. Yeah, actually, that is a correct answer. So let's just move on M&A perspectives. We have Mr. Wadhawan, and Mr. Wadhawan brings a lot of experience. And yesterday I was reading that there is a company, Syngenta India. And what has happened in that company is that that company got delisted many years back, and now there is a capital reduction happening. There is some voice. Yes. Yeah. So what has happened is that NCLAT has ordered to pay fair value to the shareholders. And that reminds me of a case which Mr. Wadhawan would recall very well, that is Cadbury India judgment in case of capital reduction. So M&A brings to my mind, first of all, minority shareholders. There are many proxy advisory firms who are giving their comments on M&A, whether you should do or not. Minority shareholders have got activated. The kind of valuation expectations sometimes is not reasonable. So what are your perspectives, sir? You can just share.
See, I would like to answer it in a very generic manner in certain ways. See, a minority shareholder depends on what the situation at a particular point of time is. When you're doing a valuation for any of this delisting purposes, the company is already delisted, right? Typically, if you were to go into any other market, there would be much more issues around, whether illiquidity, the discount around aspects like minority and majority. In India, unfortunately, there are not many studies which are available to that extent typically, and others are here who would have operated in other Ashishas there and all that. And in developed markets like US, UK, or even in Singapore, the discounts for a minority can be as much as 40-45% vis-a-vis majority, right? And we've also seen in Indian context that typically people pay a premium of 25% to getting a control sort of a thing, or varies again across industries from 15 to 40 and all that. But I just use it as an indicator. Now, what happens now? Unfortunately, in India or in a number of places, the issue which comes up is the valuation fair? On what basis the valuation has been done? It's at the end of it, it's a transaction between the shareholder and the company, right? You as the valuer perform the valuation, you give the report. It's a justifiable this thing. It is up to you. Now comes the critical question, which is can I force? Is it necessary for the minority shareholder to accept it or not accept it? Fine. Till a couple of years back, it was not. The law now gives majority to the flexibility to do it. Now comes the question of how many people, the entire process followed in valuation, and that's the way someone should look at it. If there are 5 people who do a valuation, you got two valuers, you got two merchant bankers coming in, providing a fairness opinion on that valuation. There is an independent board, right, over here, who's supposed to be protecting anyway. The independent directors have been required to protect the interest of the minority shareholders. So they've gone through all the workings, and that's how they're recommending it. I don't know what extent, what more can be done by anyone in that sense. You are getting into the fiduciary responsibility of an independent director or someone else who's there on the board and is recommending. He's seen all the stuff, right? And I will draw an analogy. It's not a question of Cadbury, and I recollect that this happened way back in early 2000s also, where there was one valuation which was carried out by one firm, another by another firm. Court decided, okay, let's get another third valuer to come into it. And again, when the third valuer also gave a report, it was in close proximity to this thing. Now, typically in any large organization, not getting into a small outfit, but typically a company will have a board managed company will obviously have its own plans and everything, right? Which would have got approved from the board. They would have gone through the process and all that. And a person performs the valuation basis that.
Yes, you're right, sir. But what has happened is that, valuation has become a soft target. And so I would like to ask this, I would like to connect it with Mark. And Mark, is there any guidance in the international valuation standards on, a valuer has performed, done the diligence, submitted a report. He could have given, another valuer might have given a different valuation. You might not like a report at all, but is there a guidance on to what extent a valuer has to do? Because as far as the standards go, standards give us the principles. But how do we apply the principles? Maybe whether CEIV credential is helping on this. Please.
Yeah, that's an excellent question. I think one, standards by their nature, and I think you point to IBS are typically principles based, right? They're providing guidance as far as the technical aspects of valuation, but obviously each situation is different. So we're applying principles similar to accounting standards, right? IASB. As far as how much work needs to be done as opposed to how to do it, I think you're right on point, Chandler. At least one thing we can point to is the Fair Value Quality Initiative here in the United States. When they developed the CEIV credential, they developed something called the Mandatory Performance Framework, which is a requirement for CEIV credential holders that in order to it provides guidance to them that they have to follow how much work has to be done. So for an example might be if management gives you prospective financial information, you just can't blindly take it. You have to go through certain steps to ascertain that prospective financial information is reasonable for use of it. So right now, the only thing I'm aware of as far as the how much is something like the MPF.
Yeah.
And just quickly distinguishing MPF is a framework. It's not a standard per se. So there's a difference between ethical standards, technical standards, and then frameworks.
Yes. So coming back to Mr. Wadhawan. So sir, how do you see that the M&A valuations are typically different from, so one, there is a controlling stakes involved, but how is it different and from the other valuations? Can we compare the private equity, venture capital M&A valuations with other kind of valuations?
I don't see the valuation principles remain the same, right? Now the question is, when a private equity investor is investing into this thing, into any startup or something, like what we used as an example of Zomato, right? Or even let's take an example of a Flipkart. The valuations varied at a particular point of time when the investors were coming into the entity, or whenever they were investing. Valuations always at a particular point of time, right? And they invested, and in fact, in certain cases, let's take the case of Flipkart itself, the investors did write down at a particular point of time the valuation. From a 16 billion number, it came down to around 12 billion or something like that. People have taken those calls on the basis of the reporting which they may have had to do, and the circumstances over here. Like Ashish spoke about today, the markets are at in a pretty buoyant mood because so much of currency or the gunpowder is around, and people are investing into this. So people are also willing to take perhaps higher risk, invest, and it's like the 20s, the kids who are just getting into the jobs, they are also getting associated with the markets. We perhaps could be going through a revolution. If you look at it, typically in early 90s, early 80s, people used to think more about manufacturing company. Look at GE, what are we going to invest? That there are tangible assets, this and that. Then slowly things started moving towards the IT or the services space, right? And now we are moving towards the technology space or the view which is being given out in technology. Now, the key question over there is when you are talking about technology is, what qualifies as a technology. You also had a situation like, a WeWork situation where there could be a meltdown because at the end of it, you are not in a similar situation that what are you doing it? You're getting rentals accumulated and then putting it out on this thing. So investing in a transaction when you're doing evaluations for a private equity, you are primarily financial thing could be the driving factor over there. One of the critical things is when do I exit out, or how much return I make and all that. Whereas typically when you're trying to do a M&A, and I'm saying it's like a merger in a normal sense that two corporates are deciding to merge or something of that sort. They're looking perhaps at much more on the synergy side, what the combined entity valuation can be, and then the evaluation goes into this thing. Eventually, the whole idea of any M&A transaction is that transaction should be value accretive to the shareholders, right? Otherwise, why would I buy something if it is going to destroy value for me? Those are certain underlying principles, but if you're talking about a company being taken private, let's take the example of Vedanta, right? They also came out with an offer when the commodity cycle had not taken an upswing, and they came out with an offer at a particular price, but the shareholders did not accept it because they felt perhaps it's worth more. So those are, it's like what you say, price is different from value, right? So it's up to shareholders that they can negotiate, they can ask for a higher price or not.
Yes. And probably one learning is that, transactions are taking place at the equilibrium of demand and supply. I mean,
see, that I think is a function of right now, the global economy, the kind of currency which has been printed, whether you take a look at US, in India, the deficits have gone to a different level, right? And that what has happened? So everyone is also looking at, there are fewer quality stocks which are available and people are willing to risk also. The risk-taking ability of the individuals is much more. The other thing which you've noticed is, let's take the case of US and other places where you have the youngsters or people are able to take calls, and they are even able to take large funds or investors to the wall, right? They can understand with the complex logarithms and all that, they can work out whether a market has been short sold, a particular stock has been short sold, let's cover it up or take it to the other position. But those situations are not based on so-called value, right? But they could be based on people are taking position of the advantage of the situation in a particular stock positions which are there in the stock.
Yeah. And I was just looking at the data. So if we look into the 7-month IPO numbers, I think India has crossed 42,000 crores. And with the other IPOs in pipeline, it is expected that year 2021 itself will cross 1 lakh crores. So, and this 1 lakh crores doesn't include the divestment plan from LIC, which could itself be about 50,000 to 1 lakh crores, maybe just at a 5%, 7%, 10% stake. So what happens ideally is that once we move away from M&A and once companies reach a saturation stage, that is typically at a level when this IBC code come into play. Because we have touched upon the growth stage companies, startup companies, but the way these distressed companies are valued is actually different. So I would request Vineet to just share his perspective and practical experience on how the distressed companies are differently valued than the startup and growth stage companies.
Good morning and good evening, everyone. Well, very appropriate question, because all valuing a growth stage company and valuing an IBC company or company which is undergoing stress at this point in time is entirely different. The first thing that we notice is the availability of data sets. The data sets are seldom available when you are valuing an IBC company. The quality of data that is available could also be questioned. When it comes to valuing an IBC company, we are primarily valuing the assets of the company, whereas when you're valuing a growth stage company, you may be valuing an assets of the company, but you could also look to value. You could look to do an enterprise valuation through income approach and various other approaches that are available, which generally is very difficult in the IBC stage. What happens when you're valuing an asset of a IBC company, you need to carry out physical verifications of various assets, including inventory, whether the data sets are available to carry out those physical verifications, whether the assets have been identified and stored correctly, whether the verifications could be carried out in an ideal situation is also a big question. As I mentioned, you're primarily valuing the assets in the IBC company, and when you're as such valuing the debtors or the loans and advances and other such SFA assets, whether the balance confirmations, most of the time balance confirmations are not available. The correspondences pertaining to recovery from such debtors or loans and advances are not available. What if there is any dispute under those balances? What is the status of those disputes? Whether enough activity has been done in order to resolve those disputes and recover those balances? Whether the corporate or whether the RP resolution professional does have enough information to continue with respect to recovery of those assets is also a question. Most of the time we have seen the resolution professional hardly has information to conduct appropriate measures to recover those disputed dues. What do you do in such cases? Also, one of the critical things is in an IBC stage, you are expected to value a particular asset on an historical valuation basis, as on a particular date in past. Most of the time, you hardly have a market value of such assets available at the historical date. Whether do you consider the events occurring after the balance sheet date or the valuation date for the purpose of your valuation is also one critical point. In fact, here IBSC, the way it is has defined, and probably valuation standards that we follow in India have defined it differently. The standards in India do mention that you could consider events occurring after the valuation date for the purpose of valuing an asset as on the valuation date, which also throws up critical issues while valuing such companies. Also, a lot of challenges that are thrown up while we are valuing IBC companies is the maximization of value is at the forefront for any RP, and you end up you are always asked for valuing an asset which is not forming part of that balance sheet. For example, for infrastructure company, say pre-qualifications form a major part of an entry barrier for any infrastructure company. How do you value such pre-qualifications? Does such pre-qualification have any value? Primarily, if you really ask me, pre-qualifications does definitely have value, because that is an entry barrier for any infrastructure company to enter into that particular field. But then, do you really have data sets to be able to carry out valuations for such pre-qualifications. These are some of the challenges that we keep on facing while we value companies under IBC stage, and there are no easy answers to that.
Yes. Thanks, Vineet. So I would just like Ashish, see, there are a couple of very interesting points you have made, and I totally agree with that. One is the limitation of data. Now, if a valuer is doing valuation and the data is not available, Ashish, and I would also come to Mark also and to Mr. Wadhawan also, what is how do we facilitate? Because there is certain guidance on assumptions and special assumptions in the IVS, but if the valuer writes in the report that I have not got this data, is the valuer, if that's the valuation compliant with IVS? Ashish, first you, then Mark, then Mr. Wadhawan.
Sure, gladly. So yeah, in the past, before IVS came out, we could have done that, taken on a mandate, do a valuation. As you're going through it, you realize certain information is not available, and that limits the ability to, say, use a particular approach. I think over the last few years, that has changed. The thinking has changed, the approach has changed. There's a lot of time spent and a lot of stress before taking on the engagement to assess what's available. And say if for a certain mandate, there's any reason that you say can't do, let's say if PFI is not available, if there are no projections available and you have to use just a market approach, then you put it in the engagement letter itself. So that helps us align with what is the requirement under IVS, because what IVS says is have your scope clearly defined. So the scope is clearly defined, and then you follow through on it. If it is during the process of the engagement, then you have to put relevant disclosures. Now, if you're looking at what to do when the information is not available, I think that's very case-to-case specific situation, and it can be a conversation in itself. But from what I have seen over the years that I've been doing valuation, you can usually find some reasonable way to assess a number. And maybe if I take IBC as a particular specific situation, the focus on IBC is looking at the asset cost or the asset value. So if there are no projections and no PFIs, that's totally fine, because the purpose is very different. And again, IVS talks about that too. It says it's a liquidation value. It's not a for sale value. It's a liquidation value. Yeah. So that again does address that. Yeah.
So let
Chander and Ashish, and I have a question here, and which is an important one. So Ashish, when you say, so now if there is an asset which we cannot value, or where the data sets are not available, we do mention not ascertainable. Okay, whether can we mention not ascertainable, or should we mention zero? How should we? And if you mention not ascertainable, while the table of assets shows value net of not ascertainable, and as you are aware, generally people look at the bottom of the table as the value and not what is in between.
Yeah, so the way we've dealt with that is you won't put zero, because you can't ascertain that it's zero. So you're right, you should go not ascertainable. And again, getting prescriptive here, which I shouldn't have, but if it's not ascertainable, it is not ascertainable. And as long as the due process has been done by the valuer, you cannot be faulted on it. And I go back to one of the questions Chander asked in terms of at what point can you pull up a valuer for what they have done or not done. You'll be surprised, there's case law which says that if a valuer has a mathematical error in the model leading to a particular wrong value, you cannot fault the valuer on it. There's an error, too bad. There are very limited areas in which under a legal situation, a valuation will be thrown out. And those are all around process, negligence, and good faith. So the onus of doing it right comes from standards and processes, because even in a litigation situation, the stress is have you followed the right process? Have you done all that you could?
Yeah.
And as long as that disclosure is there, I think should be fine. And Mark, maybe you can say I'm all wrong.
No, I mean, I agree 100% with what you're saying. I think it's a matter of transparency and disclosure, both if you can in the engagement letter and in your report, so that the reader is aware of if there are any limitations or changes on agreed upon scope, that the reader is aware of that. And if you can measure the impact on the valuation, perhaps do that as well.
Yeah, and that recalls me of the draft valuers bill, which is actually pending in India. And a very interesting point which I see there is that the valuer bona fide is presumed there. So unless and until it is proved that valuer has done something otherwise, the bona fide is presumed. There are some other issues, but yes, that is one point. So I think we have about 5 minutes with us. So maybe we can all take 2 minutes, 1 to 2 minutes each, and just summarize the session, please. Mr. Wadhawan, your final thoughts.
So I think I agree. The important thing is about the disclosure, what you got and what you cannot get, and on what you can take a call. I think that is a must. The important thing over here is, and what Ashish spoke about, I was going to talk about the similar situation, right? See, if a valuer has followed the process, Chander, your judgment and my judgment can be different. I may apply a 10% discount, you might apply a 5% discount. That's within our judgment. That's why they call valuations the art or a science, right? It's science in terms that the processes to be followed or the approaches to be followed have been defined. The principles have been defined that this is the way you need to do it. Now, the art is the experience of the person who is performing a valuation, the calls which he's taking. Is he taking the right call? My call or your call can be the same, but there can be a difference of opinion on the discount which I may apply or you may apply. That is a different thing. So the key question which everything comes down to is, has the valuer followed the right process? He's followed the right process. Has he done enough work on it, this thing, and that can be justified or supported? Now, whether it goes into public domain or it is put out in the report, that is again a very, very tricky question, especially in a country like India or any other place. It can be a very tricky question because let's take the example, if you're doing the valuation for a minority shareholder, he anyway does not have access to the long-range business plan. All those plans are being made by the board, and independent directors who are supposed to be protecting his interest are taking a look at it when all those things are being done. Now, is there a possibility of any of the future information being viewed by a regulator as a forward-looking statement? Can it open up the entire company to it? The other is, can that information be also used by a competitor for a business plan? So disclosure of information is a case-by-case situation. How it is displayed and set out has to be again taken in the context of each individual transaction. But your working papers and your engagement dynamics, or initially when you enter into an engagement letter and all that, you should absolutely make yourself clear. This is what is going out. And that's how you should write out your report also. And if any regulator or anyone's got any question, all that, those supporting documents can be provided and that can be worked out, At the end of it, in any profession you are, each profession carries some risk or the other, right? So you can't say that as a professional, my work cannot be questioned.
Yes, you're right, sir. And that makes me believe that even though India is still formulating the valuation standards, but I think we all would agree that even in 30-40 minutes of discussions, there were different deliberations and different options which came up. And probably IVS, even if adapted, or even if India makes its own standards, if we adopts ICAI valuation standards, it will be more application and following a proper process. that will actually make a valuation strong, whether it is an M&A. M&A brings special importance because there are minority shareholders, there are proxy investors, people are looking at it more. If they look at a normal valuation as well, probably the same kind of questions would come. The kind of assumptions, the kind of special assumptions that are being disclosed, whether the process is followed, whether the standards are followed, and at the end of the day, what is the kind of judgment that the valuer is taking. So probably I see that, yes, the ecosystem of valuation in India is still at an evolving stage. And yes, at this stage, the benefit or doubt should go to the valuer as far as the bona fide is concerned. And we must learn, add more of the knowledge value additions, because there are a lot many webinars now started happening on topics like valuations. And rather than going too much into technicalities, if a valuation passes a thumb rule, then I think that is a better valuation rather than a valuation in which we are debating of a number of complicated inputs. So with this, I think we are at the end of the session. Any panelist, if you want to add something, please go ahead for a minute, and then we'll move it to the third panel.
I'll just quickly add that I would encourage everyone that's participating to think of themselves as part of a global profession. And in accordance with that, it aids the public trust in the type of work we do.
Yes, that's right. Yes, Raj, over to you.
Yeah, thank you so much. I think it was really interactive, and those people who are interested in valuations, I think this was one of the sessions to attend. Thanks, Mark. Thanks, Rajan. Thanks, Ashish, Vineet, and Chander for moderation of this particular panel. With this, we will move to our next panel on regulations. And Deepika, she's founder with Transic Corporate Advisor. She will be moderating the session. So I'll request Deepika to switch on her video. Yeah, Deepika is there? Right. Hi, Suraj. Hi, Peter. Hi, Sanjeev.
Hi.
Deepika, over to you. You can switch off. Yeah, now you can not go ahead.
Thank you, Raj. Good evening, everyone. I again thank you for joining us today and hope all of you are in good health and keeping safe. I would like to introduce my co-panelist, Dr. Sanjeev GEMAWAT, Executive Director and Group Company Secretary, Dalmia Bharat Group, Mr. Suharsh Sinha, Partner at AZB. He's an insolvency and bankruptcy practice. Mr. K.R. Narayanan, Vishwanarayanan. He is a corporate transaction advisor, having first-hand transaction experiences in companies like India First Insurance, DSP Merrill Lynch Mutual Fund, Birla Life Mutual Fund. Mr. Suraj Malik, he's tax partner at BDO India. Mr. Rahul Dhawan, who's a corporate legal advisor and having rich experience in transaction documentation and have worked with Lakshmi Kumaran and Sridharan law firm. And also I welcome Peter Wass, who is partner at Loeb Smith Attorney, an offshore corporate law firm. So welcome everyone. Friends, in this third session today, we are deliberating on tax, legal, and regulatory aspects of M&A transaction. M&A transactions, as we all know, are complex and very time consuming, and they need very proper planning, strategizing at each stage, whether it's time for deciding the structure of a transaction, carrying on due diligence, arriving at mutually agreeable valuation, deciding on consideration and payment mechanism. And even while putting in the agreed terms in a document and executing a definitive agreement. The first thing after we have closed in the parties, we discuss or deliberate upon is the structure of a transaction, which can vary from being an asset purchase and taking the liabilities only related to the asset we are taking, or it can be an acquisition of an entire company by way of share purchase. Another way which we do is mergers of 2 or 3 entities together. The consideration or the mode of payment, whether it has to be an equity or cash transaction, is also to be decided upfront. And the time of consideration, whether how to make the payment, whether the payment is to be done in a one go, it has to be deferred and linked with various stages and approvals, or in the escrow, whether we need to have an escrow or duration, and the percentage of escrow. We recommend our clients to decide these things at the initial stages only of any transaction to avoid any future challenges. In any M&A transaction and structuring of an M&A, tax plays a very important role. While we advise our clients to look into and very carefully analyze the taxation aspects during their due diligence process, because tax planning plays a very important role in at every stage of the transaction, be it during the investment or exit of investment. In case tax planning is not done properly, we have seen adverse effects of depleting of the shareholders' value and loss of a sense of the entire M&A transaction. Apart from that, the challenges which we face in M&A is the other regulatory compliances and what approvals we need. In India, we have plethoras of law which is there governing companies, starting with Companies Act, wherein there's a detailed process and procedures which we need to follow, starting from the board approval, shareholders approval, need of NCLT approval, RD approval in some transactions. For cross-border transactions, we have to comply with FEMA laws, RBI requirements, pricing guidelines, various reporting requirements. In case of listed companies, we have issues like procedures under ICDR, takeovers, and these days SEBI is very proactive in insider trading. So we have to ensure the compliances of insider laws as well. For specific nature of companies, competition law is also very important. We need to obtain pre-approvals of Competition Commission and also ensure compliances in our agreement. There are other sector-specific laws which are there, like for insurance sector or telecom sector, wherein we need to obtain approvals of these sector regulators. Environment laws and labor laws, which we used to take casually earlier, they have also become very stringent these days with increased awareness. Latest amendments in labor laws is also to be considered. So friends, while structuring or while advising any M&A transaction, these approvals, etc., also have to be kept in mind, because wherein the sometimes approval takes a lot of time, whereby losing parties can lose the essence of the transaction because of the delay approval. So we suggest our clients to link the payment, if possible, with some of these approvals also. And what all approvals are required should be considered pre-hand in case of a transaction. Regulators these days have become very stringent. We have they are introspecting each and every transaction with very closer eyes. We have seen what is happening in PNB housing these days, wherein SEBI has questioned the requirement of valuation report basis the articles of association of a company. So a very close look into the transaction structuring, all the pre-necessities of approvals, etc., should be decided upfront and discussed upfront between the parties. Our panelists today are having experience from various fields of law and industry, whom I'll request to share their first-hand experience in dealing and closing the transactions successfully. I would start with Mr. Suharsh Sinha, who is an IBC expert. Suraj, IBC is our latest entrance in M&A field. IBC is introduced only in 2016, suspended for a year, and we have seen a lot of amendment also in IBC. It's evolving, and like sections like 29A or section 32A are, according to me, these are the provisions which are giving boost to M&A activities in India. But we have also seen a lot of delay happening in IBC transactions because of litigation. So what is your stand? What is your view how IBC is affecting M&A space in India? Please, over to you.
Thank you. First of all, my apologies for being late. I was caught up on another call, so my profuse apologies. So I think, IBC has probably been one of the most landmark legislations since liberalization, I would say, since 1991. And I say that because I think this is the first time in the history of corporate India that we are seeing hostile takeovers happening. Because till date, I don't think, even there are other experts on the panel who may have more experience than me. Very few hostile takeovers have taken place in India because you always need the consent of the promoter and the incumbent manager for change of control to take place. So I think to that extent, IBC has really been a game changer. And there are 2 or 3 aspects of IBC which have facilitated it. The first is that it is a creditor in possession model, as opposed to a debtor in possession model, which we have in the US under Chapter 11. So India follows the UK model of administration, where the moment an insolvency petition is admitted, the incumbent managers are dispossessed, are suspended, and the directors are dispossessed, and a resolution professional appointed by the creditors is appointed. And that resolution professional runs the company as a going concern. So the primary threat for the managers and directors of the company is actually losing control immediately. It's not as if at the end of the resolution process you may lose control. So the loss of control happens instantaneously. It's just that it's not going to another commercial party, but to a court-appointed resolution professional. Second point to note is that initially when IBC was drafted, Section 29A was not there. I think many of us on the panel would be aware of that. 29A came about because there was a fear of moral hazard. The government felt that what does the IBC do? The IBC effectively crams down all creditors across classes and says that a certain resolution plan is binding on them. It includes not only the financial creditors, it also includes tax dues and regulatory dues and government dues. So the government felt that it would be unfair for a promoter who's errant, who has a poor criminal record, who has been running a company in an inefficient way and has made the company turn the company into a non-performing asset, etc., etc. There are a few disqualifying criteria. For such a promoter to get his own company back at a huge haircut on a clean slate leads to a moral hazard. So that was the genesis of why 29A came about in the first place. So now, if you look at it holistically, the design of IBC ensures that not only does the promoter lose control once the company goes into IBC, but his ability of getting back into the company is also severely restricted, because the disqualifications under Section 29A are not only broad in terms of scope, but it also applies to not only the promoter, but also the promoter's connected persons. So the universe of people who are debarred for those disqualifications is quite broad. So these, as a result of which, we have seen some blockbuster M&A deals. I mean, if you look at some of the large distressed accounts, SR Steel, Bhushan Steel, Alok Industry, DHFL. I'm currently, in fact, sitting in the DHFL office because we happen to be advising the administrator in DHFL. So these are all accounts which could not have been resolved had IBC not been there. Now, so I personally feel IBC has been a great success when it comes to resolution of large, complex accounts. But Deepika, I totally agree with you. There is huge scope for improvement. And in my view, the scope for improvement comes from the NCLT. So the National Company Law Tribunal, which is the bankruptcy court, there is a huge backlog of cases over there. I feel that there are 2 or 3 reasons why these delays are happening at the NCLT. Number one, the capacity building of NCLT requires to be upgraded. The number of judges is, I think the maximum number of judges we can have is about 60 or 65, and there's about 33 vacancies. So half the benches of NCLT have not been staffed. Number two, NCLT judges have shown a tendency of interfering in the commercial wisdom of the committee of creditors. So design of IBC is that once a restructuring or resolution has been agreed by the lenders, then that is binding on everybody. And the judiciary should not get into commercial matters. They are guardians of process. As far as the process has been followed and you tick all the boxes vis-a-vis the process, they should not go into the commercial fairness of the decision taken by the lenders. But NCLT judges have shown a tendency of doing that, in spite of Supreme Court judges saying that they should not do it. And third, I feel, is that they grant too many adjournments on frivolous grounds. So there needs to be the ability of judges to summarily decide matters without issuing a notice, asking for reply, etc. So because of these 3, I mean, there are other issues which I won't go into because of this paucity of time. I'm conscious I've taken a lot of time. But because of these three issues, I think urgent reform is required at the NCLT. I've even written about it, a few editorials on this publicly. I think some NCLT judges also took grave objection to it. But the point is, some reform is certainly required at the NCLT level. As a design element, I feel IBC is robust, and it has led to resolution of accounts which were unresolvable under the earlier regime.
Thank you, Suharsh. You have summarized it well. I'll just quickly have another question to you with respect to the inclusion of 32A in the IBC, wherein the companies, the corporate debtors have been exempted from being prosecuted, which we were seeing that there was huge challenge with respect to the ongoing ED investigations, other SEBI, etc. investigations which were going on. How do you see that?
So again, I think the logic of 32A is very strong. 32A basically says that if the previous management had taken certain actions which were criminal in nature, because of which properties of the company have been attached by enforcement agencies or tax authorities or any other regulatory authority, and pursuant to the resolution, a new bidder comes in. There is an effective change of control, genuine change of control, and the old bidders are no longer in place. A new bidder comes in. Then why should the new bidder be penalized for the sins committed by the old management? The new bidder should get the company on a clean slate, should get the company with all its assets, and none of the taint should attach from the actions taken by the previous management. So that is the logic of Section 32A. I personally feel the logic is very strong. The issue that I'm seeing in practice is that in spite of the fact that 32A is there, enforcement agencies, particularly the ED, in many cases have still taken the ground that the attachment subsists. And this matter, in particularly in Bhushan Power and Steel, this matter has gone up to Supreme Court. I'm not aware of the latest order in this matter, but it would be very helpful if the government agencies cooperate. Because at the end of the day, it's one arm of the government, right? It's the Ministry of Corporate Affairs, the MCA, which has passed, which is championing IBC, the Ministry of Finance, which is championing IBC. On the other hand, you cannot have enforcement directorate, tax authorities, and other regulatory authorities continuing to attach properties of corporate debtors, even where there's a genuine change of control. So I think the principle is very solid. Its implementation on the ground, I think, requires some sensitization amongst other government agencies.
I agree, Suharsh. I think Supreme Court judgment will settle this, hopefully settle this for future cases. Sir, moving forward, Mr. GEMAWAT, I would like to have your views. You have been at the upfront of so many domestic and foreign transactions. You have been involved into IBC acquisitions. Dalmia, you were in this Binani Cement you attempted, then you acquired Murli Industries. So what is your take? How acquisition under IBC is different from the general transactions which we do for M&A?
Well, there are two parts to it. Yes, I completely agree with Suharsh's views. But first, thank you very much for inviting me. Sorry, in the emotions of responding to what Suharsh said about IBC, I just forgot the basic courtesy. But then anyway, I agree with the sentiments which Suharsh has expressed. When IBC came as a legislation, Indian industry was very upbeat about it. And it was undoubtedly a revolutionary piece of legislation. Simultaneously, there were a number of other things were also happening in India. There was an overhauling of the company law. There was, IBC in place, and everybody was very upbeat about the whole mechanism. And undoubtedly, this serves a purpose in terms of our ranking as far as ease of doing business is concerned, and it helped a lot. But unfortunately, we have completely compromised the great piece of legislation. And why I say that we have compromised this, for the simple reason, Suharsh has identified three reasons that why IBC failed in terms of competency, the vacancies of judges, He talked about they're getting to the commercial wisdom of it. He talked about, adjustments on frivolous grounds. And believe me, there is only one reason for this: quality. The quality of judges was a big issue. The attitude was so negative that the best piece of legislation, they have completely compromised. I agree. These are the instances. Suharsh has given instances. The fact is, a hearing which can take place in 1 day's time, there would be number of adjustments for that. Even today, if you notice, the courts are not, COVID cannot be an excuse in perpetuity. How can COVID be an excuse in perpetuity when other courts are functioning? But still, how many courts are right now performing to their optimum level? Forget about the best level I'm talking about. Even at the minimum level, they are not operating. So IBC as a piece of legislation was a great piece of legislation. But then if you see the history and the performance of IBC, in all, we have been successful in revival of only 13% of the cases. And in terms of the recovery of amount, we have not done tremendously well. We have reached up to around 39 or 40% of the amount of recovery. But then in the earlier regime also, we were at 39% for 40%, or perhaps 42%, I think, in the earlier regime. Now, if you see those numbers, then you will see that, no, we have not done great work in the process. But perhaps somewhere we have reduced the timelines because of the certain strict timelines provided in IBC. But those, whatever timelines were provided, those timelines were completely compromised in most of the cases. In majority of the cases, timelines have been compromised to the extent that even the liquidation cases, you will be shocked that the liquidation cases gone beyond 1,000 days. I think average was around 460 days or whatever, but yes, then the on around 1,000 days. So somewhere there is a fault. There's a fault in terms of the justice delivery system and or the implementation of IBC. But then it doesn't stop here. What the Indian industry is suffering. Indian industry, when an acquirer comes, well, of course, I will give a brief comment on 29A and 32A as well. But then largely, today, we don't have acquirers in the market because most of the acquirers who were having those financial capabilities or the other capabilities, they themselves are under bankruptcy. So how many acquirers we have in the Indian industry today? Very few, very limited. Above all, then we have compromised as far as the justice delivery system is concerned in terms of delays. And so to the extent, the value as far as asset is concerned, that would go absolutely down. Now, the example is that the Suharsh did mention that creditors in control concept. This IPC piece of legislation is creditors in control. And I think there lies the basic fault. That a creditor, if suppose he takes over the company, his interest cannot be the revival of the company. His interest is to encash his money, to recover as early as possible. Famous English saying that a bird in hand is better than two in the bush. And obviously that principle would get applied. So basically, if you notice, the creditors in control concept cannot be the revival of the company. But then I am happy because these laws get evolved, laws are evolving. Today, when I say that if the Supreme Court says that no guarantors would be liable, yes, that particular position where the guarantors are liable, and coupled with a change in the legislation, the pre-packaged, insolvency today, what we are having. Now, today, it might be for the MSME sector, but then tomorrow, if suppose that gets spread to all the sectors, then there would be a situation that there would be creditors in control and debtors in possession. And that would be the time that there would be a period whereby debtors or the guarantors, they would do something about revival of the company. And perhaps that would be the solution. Solution lies somewhere there. I differ with this particular concept of Section 29A. 29A perhaps might be relevant in those kinds of situations where there's a growing market, where there are so many takers available in the market. Now, 29A doesn't address what are the genuine lapses or the genuine failures and the not so genuine failures. I think unless you make that distinction and then you debar people from in terms of entering the market, I think this would be unfair to the industry. This would be unfair to even the economic growth of the nation. Suharsh did point out, and I think you asked that question on 32A. The fact remains, one is the Indian industry suffers because of the the justice delivery system. There's a delay, there is no accountability, there's an attitudinal problem, there's no quality of judges at times. At the same time, when you implement these plans at the level of various states, mufassil areas, districts, and various other locations, the fact is, there is no combined feeling of making this a success, that the revival is the objective of all. And the revival, when I say revival is the objective of all, but if a revival happens, state government would get revenue. But then are they really concerned about it? Whether the local authorities are concerned about it, whether those labor departments, once you acquire the company, they will just give you a notice and attaches your bank accounts for all those past dues of last 20 years. Now, is this the revival? Can the revival happen in this fashion? There would be one or the other cases, and at times frivolous cases, that gets filed in the Indian courts and they get entertained and the orders gets passed on that. So when we talk about 32A, I say that even 31 says that this resolution plan is should be complied by all stakeholders.
I agree with you, sir. That is what happened.
That says so. Then why are we talking about this? Are they really following this? The answer is they are not following this. I'm not
even
too sure.
After introduction of specific 32A, we had hard times convincing authorities that it will apply.
But then 31 also provides that this should be applicable. But then still, are they really complying with this? Now, this is what the Indian industry is facing the problems. But above all, are Indian courts coming to the rescue of these acquirers? Perhaps answer is no. Perhaps answer is no. Are they really following law? If suppose in these kinds of economic legislation, Article 142 gets invoked, I think then there's a challenge. I don't think that would be the fair thing to do. So this is one part in terms of justice delivery system and the Indian bureaucracy, where an acquirer would have to undergo various challenges and issues.
Sir,
and,
I would.
Yeah, please.
Sorry, we have a little limitation of time, but I would agree with what you have said, and I would summarize it like that: the provisions in the Act have been duly amended, brought in, but we need to do a lot of capacity building at the judiciary level. Moving forward, Suraj, I would like to have your perspective, your comments from the tax for the tax issues which we face in domestic and cross-border transactions, specifically with respect to the changes in GAR. Please give us your inputs on that.
All right, thank you, Deepika, and great pleasure to be among such esteemed company here. And the Suharsh and Mr. GEMAWAT, what they've said, right? There's great deal of emotion in what they're trying to express, because I think
coming from first-hand experiences of this.
And there's subjectivity in an objective law. I think tax is something different, where the law is objective and the purpose is, of course, revenue for the government. But in any transaction, the creativity goes for tax because it's a transaction cost. And as advisors or as clients become creative, the law will always catch up. And that's why we have things like GAR and all, which is essentially saying that, there has to be more substance to what is done. And just because, the form in which you do a particular transaction, you shouldn't be able to save taxes. It's been there in the law for a while. We still don't have any jurisprudence on GAR. That's, in a way good, that it's not been invoked left, right, and center, and there are safeguards. But what the government has successfully done over the years, and maybe last year budget was in particular targeting the garable things people did on transaction structures, and then the law got changed. So, we had one judgment, and I'm just going to talk about 2-3 themes where now we have code in law to say that you can't be very aggressive about your planning. One was this whole concept of claiming depreciation on goodwill. There was a Supreme Court judgment not a greatly speaking one, but where silently, the concept of that if you even do a tax neutral process like a merger, but given how you account for mergers and you do a fair value accounting, if there's a goodwill that emerges, that is tax amortizable or deductible. And people started relying on it. And as I said, people get more creative once there is, the act is the act, but a Supreme Court judgment is law of the land. And a great deal of planning went into it. Today, when the law is changed, the collateral damages, while the law clearly says you can't get depreciation on goodwill, they've taken it now because the lawmaker is playing catch up. They've also said even if you pay in a slum sale or in a carve out situation, and acquired goodwill is no longer depreciable. So the revenue authorities have taken it to the other extreme now, and that is what the code is. Similar thing, like we had this whole concept of slum sale, right, which was made. There were changes in law which was taxable, and people got into the territory of what is not a sale. Let's say it's an exchange where you do a the consideration is not in monetary terms. And again, we had jurisprudence coming in at high court level as well to say that what is an exchange is not a sale, so you can't tax it. What has happened in law now is that they've clearly specified that irrespective of the mode of the consideration, if there is a sale, there is a taxable event and you need to pay on tax. So really the substance is what the law is trying to clarify, that you need to look at, and not just the form or not just the consideration in which you have particularly conducted the transactions. Even within slum sale, when people would have, in the past, we have anti-avoidance provisions that you can't transfer shares below a particular value, and there are rules, and there are anti-avoidance provision in relation to transferring land and other stuff. People used to often package this as part of slum sales and claim that the particular rules or the valuation principles didn't apply when you packaged a land or a share as part of a slum sale. And again, the change that not GAR, but the law itself brings in today, that now if there are any of these components that are part of an undertaking, whether it is land and building, whether it's shares, securities, etc., there is a de minimis deeming value that you need to consider to price your slum sale. And this is, impacting a lot of internal transactions. Let's say within a group, people used to take shelter of, the fixed determinate consideration. That is slightly behind us now. So case laws are emerging. I don't think GAR is something that people should be overly concerned about. It is just the government telling people that, don't get over aggressive and, follow the law in spirit. And some of these changes, because of judicial precedents, I think the trend is going there to clarify it. The good part is none of these changes are retrospective anymore. So a lot of this is prospective. So all the plannings that went into a past, I mean, there are people who are rejoicing also that at least we will not be under litigation for the past planning, and that is legit to an extent. So that I see as a positive thing. Earlier we had situations where when the law changed, it went back 50 years, and you never knew what could come and hit you. So there is more certainty for sure, including certainty on some of the IBC related tax issues, right? Those things have got progressively clarified in terms of write back of liabilities and tax losses, etc.
Thanks, Suraj. I think this retrospective, not being retrospective, is a great relief for the international investors as well. There's a kind of a certainty in the environment to that aspect. Another aspect which becomes important is with respect to the so-called tax havens. Peter, I would like your inputs. Peter is joining us from Cayman Islands, and he is an expert in cross-border transactions and economic substance regime in BVI and Cayman Island. So, Peter, how these changes in these economic substance regime is affecting the cross-border transactions? How do you see that? And if you can just also explain a little as to what is economic substance.
Sure, of course. Well, thanks very much for having me. I wish I was located in sunny Cayman Islands, but unfortunately I'm based in Hong Kong.
Oh, sorry for that.
No, not at all. You did get my hopes up a little bit. So I think it's fair to say that, in terms of offshore jurisdictions such as the BVI and the Cayman Islands, they will continue to be hugely important in terms of the Indian market. There's always talk of tax havens, how they will cease to be popular and how they will cease to be important. But actually, if you look at the numbers and the statistics, specifically in terms of the Indian market, then I think you will find that they speak for themselves. So I just looked at the stats for 2019 to 2020 compared to the year prior. And I found that actually a total of 3.7 billion US dollars was invested into India through Cayman companies, which is actually up 267% from the year before. And the BVI pushed in with a total of 262.5 million in 2019 to 2020, up from 46 million US in the year before. Now, I'm not saying that the BVI and the Cayman Islands are the most important offshore jurisdictions for India, because we all know that Mauritius and Singapore are probably the number one and the number two. But I think those, figures are really reassuring in terms of addressing concerns that people might have that offshore is going away anytime soon. I don't think it is. Now, you mentioned economic substance in your question. I think this is one of the reasons why investors, financial institutions, and so on and so forth have been pessimistic about the involvement of BVI and Cayman in a market like India. For those of you that are not too familiar with the economic substance regime, it's basically something which was pushed forward by the EU and the OECD about 2 to 2.5 years ago to address base erosion and profit shifting. So in other words, the shifting of profits from jurisdictions such as India to offshore tax centers like the BVI and the Cayman Islands, purely for the purposes of avoiding tax. Because of course, those jurisdictions have either very low or little taxes, and the entities which would typically move their profits to those locations would have no substantial activities in those jurisdictions anyway. So it was a challenge. The EU and the OECD really pushed to tackle these issues. How did they do that? Well, they did that by starting to blacklist member states which didn't want to comply with their regulations. As a consequence of that, many offshore financial centers now, such as the BVI and the Caymans, have introduced economic substance legislation in order to avoid being blacklisted. And the enforcement remains untested because the regime is still new, but the penalties for not complying can run into hundreds of thousands of US dollars. So this is really important. And the rules basically say that if you have BVI or Cayman entities conducting certain types of activities, then you need to have physical substance in the BVI or the Cayman Islands. And that could mean having physical office space there, having employees with appropriate qualifications, generating expenditure there. And I think it's for those reasons that many investors, financial institutions, etc., have been pessimistic about the survival of offshore jurisdictions. Now, if you look at the legislation, though, it is quite commercial and it is quite pragmatic. And I say that because it recognizes the reality that many offshore companies are used for holding purposes, or alternatively, they are used as investment funds, particularly in the Cayman Islands. And in those instances, the requirements under the economic substance legislation are significantly reduced. And so actually it's relatively easy to comply with it in those cases where you're looking at holding companies, and actually investment funds completely fall outside the scope of the economic substance legislation. Now, there was some concern recently because I think it was on the 30th of June that the legislation was amended in both jurisdictions to capture partnerships. And so there was quite a bit of panic in terms of, clients who've historically used partnerships in our jurisdictions, that all of a sudden they need to comply with these really onerous requirements. But actually, for those of you familiar with offshore jurisdictions, You will be aware of the fact that partnerships are mostly used in investment fund structures. And again, the legislation is quite pragmatic because it realizes that there are genuine reasons for using these jurisdictions other than tax evasion. And so investment funds actually fall outside the scope of the economic substance requirements as a result. So I personally challenge those people who think that offshore financial centers are going away. They are not. There are genuine reasons for using them. We are seeing a lot of increased regulation, not just in the BVI and the Caymans, but other offshore financial centers. But I think they will very much remain to be used for legitimate purposes.
Thank you, Peter. We also hope more transparent and compliant structures, see these kind of structures in future. Again, I'd say that you have emphasized on the compliance part. So I would now request Mr. Vishwanarayanan. Sir, if you can throw some light on the importance of compliances which are needed while entering into any transaction, from your experiences, how a non-compliance can result into the fallout of a transaction or delay in transaction.
Yeah, thank you, Deepika. Good evening to all. I think, Deepika, when you started the session, you mentioned two things actually. In a deal, right from the beginning till the end, regulatory and compliances are very important. Otherwise, it could be a deal. That is one. The second one, which you said, is about the sector-specific regulatory, which is more important in certain specific industry, is which probably I can touch base actually. We can look at life insurance companies actually, which is predominantly have a different set of accounting also. Though it's covered under the Companies Act, the entire valuation at the time of the IPO or the subsequent unlisted companies also have to go through a embedded value calculation, which is the EV calculation, as they say. The regulator IRDA looks into every liability. The liability is the entire policyholders kitty, which is managed by the insurance company. And IRD plays a great role to ensure that both for consolidation, merger acquisition, as well as for an IPO, the calculation is exactly as required by the actuarial. This is not only done by the internal actuary. There are a lot of professional firms in the country who carry these embedded value calculation to look at the liability in the balance sheet. So that is one. In the last few years, we have seen 3 life insurance company which has got listed, which is the large names, which is ICICI, HDFC, and SBI. We have seen in the general insurance, one of the government New India Assurance got listed, and ICICI Lombard got listed. And the health, none of the companies have got listed. Mergers and acquisition has happened more in the general insurance sector. On the life insurance sector, there has been no merger at all. But in public domain, everybody is aware of one merger and acquisition, which was between 2 large companies, which is HDFC and Max Life Holding Company. Did not go through more because it didn't get the approval of IRDA. Okay, it took more than 1.5 years, and at the end, the deal didn't happen. For various Insurance Act 1938 has got a lot of restriction on these kind of mergers which takes place. So M&A becomes very much regulatory approved by the IRDA. That is one. Prior to this, the regulation had given a 26% automatic route for the insurance sector, which was increased to 49%. When they made it to 49%, also they were very clear, IRDA, saying that 51% has to be Indian owned and controlled. So the IOC regulation became very important, that even though 49 could be under the FDI automatic route, 51 has to be Indian owned and controlled. They also relaxed that majority, you can say all the life insurance, general insurance, and the health insurance had foreign partners, and the foreign partners were all in the business of life insurance or general insurance or health insurance. So they relaxed something where private equity can enter. Private equity can enter initially up to 10%, and then they made it to 26%, which was treated as promoter. There's one such company took up 26%, and IRD approval came in. I handled the transaction also, where not only IRD approval, then the CCI approval, Department of Economic Affairs approval is a lot of time consuming and has to be exactly regulatory driven. That's something which you have to note. On the Indian own and control, I will just stress and saying that 26 became 49, and the finance budget 21 recently, which was announced, the 49 has become 74. So when 74 is there, likelihood that the IRDA is amending the Indian own and control regulation. So I think the transaction has not taken place, but there's really a lot of capital can come in through this, because insurance for the liability to be managed, huge capital is required, and that can be definitely come through a lot of foreign companies actually. So that is on the Indian own and control.
Thank you, sir, for your insight. I think we need to actually push hard for the, yeah, you were saying something?
Yeah, the other industry which is also highly regulated in terms of regulatory is SEBI, SEBI,
yes,
which regulates the asset management company and the mutual fund. And there also recently, there's a press report which says one of the large conglomerate which was trying to list the company could not get it because the sponsor of because every asset management company has a sponsor. And the sponsor had some kind of remarks in the file which is blocking it, but probably they're trying hard to get the approval. So the regulatory approval on SEBI on this public issue has also been held back. So there are a lot of delays which happens in these terms of mergers, acquisition, money raising, private equity deals, and everything. Yeah, you telling me something?
Yeah, I was saying that yes, these regulatory approvals do take a lot of time, especially in India, and regulators like RBI and insurance. SEBI, I would say, is little faster than others, but yes, SEBI is also a roadblock many a times. Rahul, what is your stand? How we can protect these kind of delays or protect our clients while the documentation process is on? Because sometimes the viability of the transaction loses because of so much of delay. And what kind of a due diligence steps we should ensure before even committing such kind of transactions? What do you think on these?
Thanks, Tipka, and good evening to everyone. Our esteemed panelists have already addressed a plethora of issues pertaining to legal and regulatory environment. And in the previous panels also, as listening to the valuation related aspects being discussed. So the key words that I noticed were the disclosure, the transparency, the positive attitude, the accountability fixation, and such things. And when we start talking of the transactional aspects from an investor's perspective, more particularly from a foreign investor's point of view. So apart from these regulatory environment, the contractual issues also become paramount. And all these things which are of utmost importance, like requiring transparency and disclosures in the transaction documents, from the first party's perspective, of course, it is expected of the second party to provide these very important giveaways in the transactions of investments and acquisition deals. But from the first party perspective, from what he's offering in the transaction is the reps, warranties, disclaimers, and indemnities. So it has to be balanced out from the perspective of interest and accountability of both the parties. You have rightly mentioned that apart from whatever we are discussing in order to maximize the investments and returns, it is very important to build the foundation right for a transaction by engaging in a thorough due diligence exercise and to construct the deal on the premise that is suitable and fruitful to all. So obviously, when an investor examines the potential deal for investment opportunities, the first thing, of course, that is required to be examined is the decision over which group entity should be the flag bearer in terms of the tax jurisdictions, and as Peter has pointed out, Singapore and Mauritius remain the front runners in terms of the tax jurisdiction, the investment havens that they are, and British Virgin Islands and Cayman Islands are also not far behind. So after examining the issues that the investor can address at home first, that is deciding over the type of entity, the jurisdiction from where the investment can flow into the targeted investee company. The other points that are to be decided depend upon the discussion and negotiation with the other party, which we try to articulate in the joint venture agreement, which serves as the constitution of the understanding between the parties for a great length to come. Because the basic governance, of course, is provided by the prevailing legal structure, but the inter se understanding between the parties, that is also equally important to be addressed in the right spirit, so that it gets captured in the transaction documents transparently and fairly vis-a-vis both the parties, so that it serves the purpose for which they come together to incorporate a joint venture company. So after having shaped the initial investment structure, the parties look forward to discuss and finalize over the other crucial points in the JV agreements. And if it depends upon the results that the due diligence exercise also throws up as to what kind of risks are being identified, whether they are pre-identified, potential, or foreseeable risk in future. So that paves the way for determination of the overall valuation and pricing for the stakes to be involved. So obviously, either they can cover those risks by incorporating suitable reps, warranties, and indemnities in the agreement, or it affects the acquisition price in case of the investor coming in. If the project is already set up and it contains risks that cannot be overlooked, even while additional investments being brought in, they can't be repaired to the fullest extent. So in those cases, either the promoters provide the indemnities and complete disclosures about the types of anomalies that have already taken place and how they intend to cover it up, or they offer to compensate the transaction value for the investment deal in terms of what the premium for investment should be. And
thank you. Sorry, Rahul, I'm interrupting, but we are running out of time. And I totally agree with you that reps and warranties and indemnity clauses are to be carefully drafted. I just like to add that even the material adverse effect clause has to be taken into consideration, and we should consider that what kind of approvals and delay in approvals can cause adverse effect on the company or the transaction, and incorporate it accordingly. We are running short of time, but I'll take a liberty to touch upon the last point of concern. And sir, Sanjeev sir, I would like your inputs on that. We are seeing a lot of investor awareness these days, and these proxy firms and corporate governance is like becoming hyperactive these days in all kind of transactions which are happening. So what is your take on this, whether so much of concern over minority interest is going in the right direction, or it is just something which minority investors are using to benefit themselves, and the governance clauses which are also being related to minority interest, whether they are in favor of these transactions or detrimental to them. Just quick input of yours, sir.
Well, sure. I think a very, very interesting question which you have raised right now. And very briefly, let me tell you that from a proxy firm standpoint, if somebody is analyzing the data and demonstrating this, that certain things are being done nicely, certain things are not being done nicely, or in a fair manner, if somebody is assessing any company's performance, its governance structure, its practices, etc., nobody would have any objection to that. And of course, as the market is growing, you will find number of proxy firms of this nature who would be giving that assessment. But the difficulty is not that. That assessment can be fair at times, that may be motivated one. So that is one part of it. The interesting element in this is the so-called minority shareholder, which you just mentioned about. These so-called minority shareholders with their own motivated interest, vested interest, they would be filing one or the other applications in the courts, and those get entertained. They don't have the legal right to file that, but then still those gets entertained. And to the extent, and I have observed this, for example, it's an established law today, and that Mafatlal Industries case, that the courts would not be getting into the valuation aspects. There would be certain decisions on these issues that, yes, at times court has, even otherwise, despite of that established law, the courts have, passed orders with regard to valuation, with regard to any merger scheme. That also there are, stray examples of this nature. But then you will be amazed and shocked that those people who are not even having the right to, file petitions, they are not even shareholders, but then under one pretext or the other, they file some application. Legally, they don't have any right. They are not 10% shareholder, etc. But then they would file. Schemes have been set aside by the courts. Schemes have been set aside by the courts that no, because of their interest is getting impacted. Now, what they present, how they appreciate, and that's the reason why we said that the quality of judges is very important. The attitude is very important. Why are they getting into this? Is not a mechanism of equity. It's a mechanism of a contractual arrangements at times. So I think there we face a lot of problem. Indian industry is facing a lot of problem that these things get entertained and adverse and negative orders get passed.
Thank you so much, sir. I would say that it has been an interactive, good interaction and very insightful one. We have learned about IBC, about taxations issues in the transaction, result of delays and approvals, and also the importance of documentation and various clauses in documentation. We have briefly touched upon these topics, and I think we will all agree that at this level, at a judiciary level, a lot of capacity building is needed, though there is little we can do about it. But thank you so much, everyone. Thank you for audiences for having a patient hearing. Thank you so much.
Thank you very much, Deepika. And just last one comment, and you said that we can do very little about it. No, what we are doing today, it's only we are helping public opinion to get a certain shape. And so we are doing a nice work, and I think let's keep on doing this. Thank you very much for inviting me. It was, it's indeed an interactive session. Thank you very much.
Thank you, Deepika. Thank you for the
Thank you, Deepika.
Thank you.
Thank you, Deepika. Thanks. Thank you, panelists. It was interesting conversation indeed. And Suharsh, you started really well. One of the interesting starts actually, right? Sanjeev sir, I think you were fantastic, and you shared a lot of insights into the legal part. Rahul, Mr. K.R. Vishwanarayan, Suraj, I know Suraj for a long time now, and I think he's always good. Peter, thank you so much for joining from Hong Kong. We'll look forward to see you in some other conference. With this, we will try to will thank our moderators, Chander, Sahil, and Deepika, for your able coordination for all the three panels. We'd like to thank our chief guest and keynote speaker, Nick Talbot, and Mr. Haribhakti for joining today. And thank you, esteemed speakers, for accepting our invite and attending this webinar. Thank you so much. And With this, we will conclude the webinar. Look forward to see you in other programs of Ideals Network. Thank you so much.
Thank you, everyone.
Thank you.
Thank you for joining in.
Yeah. Thank you. Thank you, Chander.